This is Bloomberg Wall Street Week. I'm David Weston. There was more talk of inflation this week, with Fed Chair Powell admitting it's a bit worse and more persistent than he'd expected, but still not really something to worry about. And natural gas prices really shot through the roof over in Europe because they have some problems with some supply chains. What if Chair Powell is wrong and real inflation is here to stay after all? What should an investor do? Still with us is Peter Krause of Aperture Investments, and now joining us is Nancy Davis of Quadratic Capital. She is the CIO and founder of that organization. So, Nancy, let's start with you, because you've made something of a name for yourself when I say that in the area of inflation. Without regard to whether you think it really is persistent or not, if it were to be persistent, what should an investor do?
I think every investor needs to be concerned about inflation, especially retirees, because you're not going to benefit from the wage inflation if you're not in the labor force anymore. So we do live in a real world, and inflation is a risk to every investor portfolio because it reduces purchasing power. I think investors just shouldn't be taking a bet on whether it's transitory or not, and really should have, as part of a diversified portfolio, should own some amount of inflation protection.
Well, just to follow up on that, Nancy, what does inflation protection look like? Is that gold? Is that real estate? What is that?
Well, I definitely have a different view about what inflation protection is. I know a lot of investors look at commodities because that worked in the 70s in the last period of hyperinflation. But I think commodities are like the laptop, I'm talking with you on tonight. It's deflationary. Technology has innovated in that space. So I just don't think commodities are the only way to think about how to capture inflation. I personally like using the difference between short and long dated rates as another measure of inflation expectations outside the consumer price index. I think that's a thing that investors have to keep in mind, is that's just one index. It's like if you were to buy equities, nobody would buy just the Dow Jones index and say, oh, I have all equities. I think investors have to be diversified.
Peter, same question to you. If you need,
I think Nancy makes a really good point about that. First of all, in the commodity inflation time period, we didn't have the same kind of technology boom that we see today. And we didn't have anywhere near these social, I shouldn't say social, but ecologically beneficial ways to actually produce energy. And Nancy's business has really focused on a long-term structural benefit that's out there of taking advantage of the difference between short and long-term rates. And she's made it liquid. And I think that if you want to buy inflation protection, that's a part of your portfolio that you could easily tailor, own, and it would give you protection to do that. You could also own commodities, but you are susceptible to supply and demand changes, political changes, technology changes. So there's more going on in the commodity world than there is in the sort of pure rate opportunity.
So, Peter, let me just pick up on something you referred to, which is what's going on with climate change and some of the things that are being done by the Biden administration and others in response to that. Gillian Tell of the Financial Times this week wrote a column in which she called it greenflation, because she said, as we make this transition, it's a massive transition away from greenhouse gases. It's got to drive some prices up. There's got to be inflation. Is she right?
I think she's right. I definitely think she's right. And I think it's a little bit difficult to calculate. So what I mean by that is, we're all going to move towards a green world. That's a good objective, and we should go there. But what we don't know is how long is it going to take us collectively as a global economy to actually get to the point where the green world is efficient, cost effective, and actually produces enough energy for us to operate our world in. And that time period, we don't know. And if we haven't invested enough in carbon fuels to actually have the supply to get us there, we're going to see price spikes. And we're going to see them actually be very rapid and actually quite disconcerting, because you're not going to be able to increase the supply fast enough to be able to deal with the shortfall.
One of the things, Nancy, clearly we have not invested enough in is supply chains all around the world. I mean, it started with semiconductors, but it's gone well beyond that. Take a look at all the ships lined up outside of Los Angeles and even here in New York. What about that as an effect on inflation? Is that going away anytime soon?
Well, it's really a result of the supply shocks around the world. It hopefully will go away soon, but we're also having labor shocks at the same time. So goods and services are not being able to be shipped around the world. Factories are not working at full capacity. And it's a bit of a catch-22 because, something's got to give eventually, and eventually the demand will be met. The question is whether we're going to have higher costs without the earnings per share growth that has been priced into corporate America. If you look at stocks and corporate credit, the markets are really expecting a lot of growth. And when you listen to some of the companies as they report earnings this season, a lot of people are talking about the labor market and the delays and the higher costs that are not necessarily growthy costs. They're more potentially a stagflationary costs, or we have higher costs, but not the earnings per share growth.
Peter, as I listen to Nancy, a lot of what she describes is the direct result, I suspect, of the pandemic. We had to shut down the economy and then bring it back up. But is it really the cause of what we're seeing, or did the pandemic reveal some underlying structural weaknesses we had, perhaps around the supply chain, having too much devoted to certain countries, like, for example, China? Is it really revealing more structural issues for the economy that have to be addressed?
Well, that's an interesting question. I think you could argue that there was nothing structurally wrong with the supply chain, although it was clearly concentrated in certain areas. I mean, remember the nuclear disaster in Japan, and automobile manufacturers realized that their supply constraints were disrupted dramatically because they were getting a lot of supplies out of Japan in a specific place that was near Fukushima. So natural events do have an effect on supply chain, and COVID had the same effect, although on a global basis. And so, now we're trying to figure out how do we diversify the supply chain so that effect doesn't happen as often. But we're always going to have some aggregation of supply because ultimately there's a benefit of suppliers being near each other. They use the same kind of labor costs, use the same kind of energy costs. And if those costs are low and attractive, you're going to attract a number of people that produce goods that have an ecosystem around them. So I suspect that you're always going to have these kinds of shocks in the supply chain when you have natural events that are catastrophic. So in that sense, I don't think that COVID exposed a weakness. It exposed kind of the persistent issue you have when you've got a global supply, structure, and effectively there's a concentration in the system somewhere.
And Nancy, finally, we have a supply shock in the sense, as you point out, in the labor market right now. And that may be just we're trying to get people back online. They're still concerned about COVID. Or there could be a more fundamental shift now that's happened because there was the disruption. It's caused people to rethink what they're doing with their lives. As an investor, do I need to have a view on that subject, whether we have a longer-term disruption in the labor market? Or can I invest in a way that I'm protected either way?
Well, I think most investors, when they look at their fixed income portfolio, especially with a lot of people have decided to retire and leave the labor force, that's where inflation, you really don't want to be taking a bet that we're not going to have higher inflation. You want to have diversified fixed income exposure. And many of the indices out there that are core fixed income do not have inflation protection inside of them. And that's because they were older indices that were created before the Treasury started the inflation protected bond market. So I would just say to investors, know what you own, try to be diversified, add lots of things to the portfolio to achieve that diversification. And I think inflation protection is just one of those things that you should have now, especially with the fiscal spending that's happening and the labor market shortages.
And Peter, sort of the same question to you. Are we seeing a longer-term shift in the labor market? A lot of people can't explain what's going on right now.
I think that the labor markets are probably not as flexible as they had been in terms of people moving from state to state in this country. I think that the low-cost labor that was available in developing markets has changed a bit. It's now higher. So that not as much labor supply is moving around the world. So I think those things are definitely in place. And I also think that we've had a long period of time of deflation in wage costs due to one, low wage areas that were manufacturing products. And as Nancy mentioned earlier, technology that drove costs down. I think technology is probably still going to provide a declining cost curve in the future for labor. And so that, I think, is still going to be a benefit. But I also think the cost of labor and the cost of high-end labor is going to continue to rise, and there is inflation. And so the sort of deflation benefit that we had in wage cost plus the technology benefit, that's what's going to change. And I think that will lead to margin pressure on companies. They're going to have to grow their top line and drive their pricing in order to keep their margins.
Yeah, it's fascinating. Really interesting discussion about inflation and the labor market and commodities and climate change. Can't get much more in than that. Thank you so much to Peter Krause of Aperture Investments and also to Nancy Davis of Quadratic Capital, where she is CIO and founder. Coming up, we take a look at the week ahead on Global Wall Street. This is Wall Street Week on Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Any mistakes you've made or failures that you can talk about so that people could feel you're not just a superhuman?
People ask that question as if the only challenge is at work. Challenges come in a lot of different packages.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is Wall Street Week. I'm David Weston. It is time now to look at the week ahead on Global Wall Street.
David, we have 3 central bank meetings in Asia next week, and we're watching to see if the RBNZ will hike after holding rates in August, as officials have pushed back on aggressive tightening bets from New Zealand. Now, in Australia, the RBA's stance on surging home prices will be closely watched, along with the recovery outlook as the Morrison administration pushes to reopen with plans to resume international travel. And in India, where the recovery is losing steam, the RBI is expected to stay accommodative, but more liquidity withdrawals are anticipated. And while Chinese markets are closed for the Golden Week break, Evergrande developments stay front and center. Danny?
Thanks, Sophie. The focus is really squarely with the energy crisis in both Europe and the UK and those sky-high prices and any response from policymakers we might see this week. Also, later in the week on Thursday, we get notes and minutes from the ECB's last meeting. Romain?
Thanks, Danny. Non-farm payrolls data due next Friday may shed light on the tightening path of monetary policy as Fed officials wait for labor market conditions to reach levels consistent with maximum employment. Remember, hiring downshifted abruptly in August with the smallest jobs gain in 7 months. Elsewhere, Tesla is holding its annual shareholder meeting. Proxy advisory firm ISS recommending investors reject the re-election of Tesla board members James Murdoch and Kimball Musk. And top airline executives from around the world will assemble in Boston for their first face-to-face gathering in more than 2 years. The International Air Transport Association meeting will focus heavily on the long-anticipated and so far elusive rebound in corporate travel. David?
Thanks to Sophie, Danny, and Romain. Coming up, the massive problems surrounding Chinese real estate giant Evergrande still aren't resolved, with no clear path ahead. But does the Evergrande story raise larger questions about the Chinese real estate sector and for the continued ability of China to drive global growth? This is Wall Street Week on Bloomberg.
a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
What have we learned from this Evergrande crisis so far?
From my investment perspective, I think diversification is very important. So far this year, we've seen many events, right? Maybe in the fintech sector, and education, casino, and property. So I think diversification help you lower your risk on your overall portfolio.
Medium term, though, are you seeing more risk and reward in the high yield space in Asia? I mean, how are you viewing this right now? Are there actually buying opportunities given just the selling we've seen?
This time is a bit different in the property cycle because in the last, when you see there's a tightening measure, there's always demand there, right? Just the government trying to suppress the demand. But this time we're seeing a confidence issue, is like a buyer strike. Because of the sentiment, the Evergrande is hurting the sentiment, and people don't want to buy. And other developer, because they want to get cash.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
The implosion of Chinese property giant Evergrande brings back the specter of the fall of 2008. That's when one of the largest investment banks in the United States saw the value of its assets plunge, setting off a crisis of confidence that ended up rocking the global financial system. It's called simply a Lehman moment, and one of the few things everyone can agree on is we don't want another one. For now, though, there seems to be no one who sees Evergrande having the impact that Lehman did.
The Lehman moment produced pervasive structural damage through the system that wasn't rectified until the Treasury came across in terms of its borrowing, and then the Fed came across with quantitative easing. But this is not that kind of a shake-up type of thing.
That's the founder of hedge fund Bridgewater Associates, Ray Dalio. Central bankers are echoing that theme. Evergrande's problems may be painful, but they probably won't be global. Here's Fed Chair Jay Powell and Bank of Japan Governor Kuroda.
The Evergrande situation, it seems very particular to China. There's not a lot of direct United States exposure. The big Chinese banks are not tremendously exposed.
While we must monitor carefully for a spillover effect on financial markets globally, at this point, I don't see this developing into a global crisis.
But Evergrande doesn't have to be Lehman for it to send dangerous ripples through the Chinese property market and China itself, according to our special contributor Larry Summers of Harvard.
People should be very much on guard here, and I don't think that any of us have full transparency into what's going on in China.
What we do know is how much the Chinese economy depends on real estate. Nearly 29% of its total GDP, much more than it represented in the U.S. economy at the peak before the great financial crisis of 2008. Here's Milken chief economist Bill Lee.
the financial instruments in China are so primitive that people really don't have a way of saving. And so buying property is really one of the most important things that Chinese families do. And right now, what we're seeing with the potential collapse of Evergrande is the question facing policymakers in Beijing is Evergrande systemic? Is it too big to fail?
All of which raises the question of whether President Xi will have to slowly deflate the real estate bubble and what that could mean for the Chinese economic growth engine the world has come to rely upon.
The possible slowdown in China is one thing that investors have to be focused on right now. Another one is what's been going on all week long in Washington. They finally got a refunding of the government done, so they didn't have to shut down the government at midnight on Thursday, but they've got a long way to go with an infrastructure bill, as well as a $3.5 or maybe $1.5 trillion budget. And, of course, there's that debt ceiling. To take us through all this now, we welcome now Bloomberg's Washington correspondent, Anne-Marie Horton, up on Capitol Hill. So, Anne-Marie, thank you so much for being with us. Give us a sense of where we are right now. I know that President Biden on Friday went up to Capitol Hill to try to, I guess, twist some arms.
Yeah, he really just wanted to rally the troops for his economic agenda. There was really a win for both sides, I would say, the moderates and the progressives. On the one hand, he said it doesn't matter if this gets done in 6 minutes, 6 days, 6 weeks, as long as it gets done. So that kind of pours some cold water on the moderates who wanted that infrastructure vote immediately. But on the other hand, he also basically said it's not going to be $3.5 trillion. Some of the representatives we spoke to said numbers around $2 trillion. We know that he's been in constant communication with two senators that really have a lot of the keys to unlock this reconciliation broader package. Kirsten Sinema of Arizona and Senator Joe Manchin of West Virginia. And Joe Manchin's number is $1.5 trillion. So you can see that that would be a bit of a blow to the progressives. But really, this was about coming to the Democratic House caucus and making sure that the path is clear for them to move forward.
Well, and that seems to me, Anne-Marie, the key point. The Democratic House caucus. This is a partisanship not between Republicans and Democrats. This is all within the Democratic Party. And I guess one of my questions from where you are, up there in Capitol Hill, is this a win-lose thing? Is there any way for both the moderates and the progressives to lose? Or does one have to win and one have to lose?
Well, the president would say that they'll both, in the end, have to win. You know, the leadership of the Democrats linked these two packages together, saying they're going to move on infrastructure, but they will only move, and that will only happen if there's also reconciliation. They wanted to make sure that these two paths were clear. And then they came under a bit of pressure from the moderates to say, why are we waiting weeks to get for shovels in the ground for that hard infrastructure package when the Senate had already passed it? So there is a sense that they all could lose if neither of these bills go through. But the president was trying to make that point clear, that we're all going to win or sink really together.
So let's talk a little bit about deadlines. We had one firm deadline, which was midnight on Thursday. The government was going to shut down. They got past that. They refunded the government. What are the real deadlines at this point? Because Speaker Pelosi keeps saying we have to get this infrastructure done, but there's no particular date by which she has to get it done, is there?
This is totally arbitrary, this date, although she did link it to the highway and transportation funding that did run out at midnight. That is something that did run out. But potentially what will be voted on Friday in the House is going to be 30-day funding to make sure that those highways could remain open and those federal workers could get back to work. Because today, David, we learned from the Transportation Department that more than 3,000 federal workers were actually furloughed. But besides that, these dates on infrastructure are completely arbitrary. And the Democratic leadership really seems to be putting them in place to just try to speed along and make sure that the discussions continue, because what everyone says in Washington is nothing gets done unless there's a deadline. The other real deadline, though, we need to watch is this X date. Treasury Secretary Yellen says that X date for the debt ceiling is October 18th. Morgan Stanley says it's probably a little bit closer to October 28th. But that is a real serious deadline that potentially, if we can come close to or hit, the U.S. could default on its debt. That's the next real deadline to actually watch.
Anne-Marie, we cannot thank you enough for being there to report from Capitol Hill on a very eventful week up on Capitol Hill. Well, it wasn't just what's going on at Capitol Hill or China that was really of interest to investors in global Wall Street this week. It's also IPOs. New York Stock Exchange President Stacey Cunningham joined Bloomberg earlier this week to talk about that IPO market. Here's some of what she had to say.
Across the board, 2020 was a blockbuster year. We had more IPOs than more capital raised than in history. And then we saw 2021 already eclipsing those numbers. What's unique about this time and very different from what we talk about when we look back at the dot-com era is the breadth of types of companies. And so, as you mentioned, we're seeing internet tech, we're seeing consumer tech, we're seeing healthcare. There's so many different industries going public right now. As the markets have become a little choppier and we're seeing investors become more discerning about which companies they're supporting, the pipeline continues to be really, really strong. Some companies are choosing to wait a few quarters before they go public, but there's still a lot lined up in the short term. And we're excited to welcome Warby today here at the NYC via direct listing. They're also thinking about how they go public, not just when.
Stacey, I notice you're wearing your glasses. I feel this is appropriate. Let's talk a little bit about the direct listing. You say the markets are getting a little choppier. Does the direct listing become more attractive in choppy markets? Do you think more companies will go down this route?
That's a great point. We're already seeing more and more companies considering a direct listing, but when you're not pricing shares and you're not selling shares into the market, you're a little less concerned about what the market conditions might be. You're allowing investors to price the company, but there aren't new shares being sold. And so it is attractive when markets might be a little bit more volatile. We are seeing more companies choose a direct listing, not just because of market conditions, though, because of their priorities. So the cost of capital is significantly better in a direct listing because you're allowing the overall market to participate. And that democratization of access to that initial listing is a really big, important driver for many companies who want all investors to have a level playing field as they hit the public markets.
Hey, Stacey, I hear your point about direct listings, and so you're somewhat immune from the volatility within the markets in some capacity. But if we get the trajectory of like yields really rising and other assets really repricing for that, do you think that materially impacts the space?
You know, I think not so much for direct listings. It's just the capital markets attracting investors. And there are drivers for why there are so many companies looking to go public. If you rewind back to the spring of 2020, nobody would have expected that we would be in such a busy IPO calendar. But it was very expensive during that time in the early days of the pandemic to raise money in the private markets. And the public markets were providing access to capital to companies who needed it urgently, desperately, and they needed it really efficiently. And the public markets were really on display. So now we've seen a lot of companies recognizing the value of the public markets. Yes, certainly interest rates are playing a role in that as well. But there are companies that are looking to be public because they're not quite sure. I mean, we're coming off at a 10, 11-year bull run market where a lot of companies recognize the fact that conditions might not be within their control over a period of time, and they're looking to tap into that capital so they can continue to grow and expand their businesses despite conditions.
Stacey, we're starting to see some SPACs giving back money to investors. Do you think that is a sign maybe that peak SPAC is behind us?
I think peak SPAC is behind us. If you think about the days where we might have a busy day and there were 20 SPACs going public on a single day, I don't think we're going to get back to those levels. There's been a bit of a reset, which is healthy for the market. You're seeing high-quality SPACs go to market. You're seeing high-quality business combinations get done. But when there are already 400-plus SPACs out there looking for business combinations, I certainly don't think we're going to see an acceleration of those trends. And just like the rest of the market, investors are going to pick and choose the opportunities that they believe are going to deliver them the best returns.
That was New York Stock Exchange President Stacey Cunningham. Coming up next on Wall Street Week, contributor Larry Summers. This is Wall Street Week.
At the low point of the Greek economic debacle, what were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic. but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
Who are U.S. Open tennis champion Emma Raducanu's 3 dream dinner guests?
Daniel Ricciardo, Michael Jordan, and Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
This is Wall Street Week. I'm David Weston, and we're going to turn to Larry Summers of Harvard, once again, our special contributor on Wall Street Week, to really take us through the week. Larry, first of all, let's start with inflation, something we've talked about, I think, every single week. But we got really some news this week, in no small way because of what happened with the 10-year yield on the Treasury, which really spiked up. It's still a modest number overall, but it climbed really quickly. And you and I have talked about the question, if we really have an inflation problem, why isn't the 10-year yield going up?
Look, it may be that this is a recognition of some combination of the fact that we're going to have more inflation and that the Fed's going to do more than people thought it was going to need to do in order to contain inflation. You know, once these things start, they sometimes have a tendency to trend. So I stand by my view that markets are substantially underestimating what's likely to happen to interest rates before too long. You know, if you look at the so-called Taylor rules, predictions of Fed behavior, and you feed any kind of traditional Taylor rule through with the way current economic data is running, it points you to a pretty substantial concern about inflation overheating. So I've got pretty real anxieties. I think what's happening with oil makes the kind of parallel that I've drawn to the 60s and 70s look more real. We just seem to be having a lot of surprising bad shocks that are lasting longer than you think. And when you keep being surprised again and again, it suggests that there's a pattern and you're missing it. I think that's a bit the case with inflation. And of course, this week we saw some growing sense that while Europe is not nearly as far along in this as we are, that even in Germany, inflation's rising to surprising levels for them.
At the same time, we have a back and forth up on Capitol Hill about spending more money, more potential fiscal stimulus. This week we had Joe Manchin, the senator from West Virginia, come out and say, I don't like $3.5 trillion for this Build Back Better plan. I like it more like at $1.5 trillion. Now, I don't know exactly what's in Joe Manchin's plan, but I remember last week on this program, Wall Street Week, you said what you thought they should do is do something less than $3.5 trillion and make it more targeted. Is Joe Manchin taking the Democrats in the right direction, do you think?
Look, I think if the bill shrinks somewhat, even more important if it's paid for, even more important if it's paid for without gimmicks. I worry about too many things being done where they're funded for 3 years and everybody assumes it'll be funded after that, or it's announced right now that it'll start being funded in 7 years. It's crucial that there be some quality to the spending relative to the revenue, rather than excessive reliance on timing gimmicks. It is hugely important that we pass a bill. It is hugely important that we start doing more than we have done on climate change, for example. And I'm not sure that we need to do everything that Senator Manchin is calling for there. I think there's a lot that absolutely needs to happen even if there is some short-term dislocation. So I'd like to see, I think it's desperately important that we pass a bill. I hope that this process of compromise will eventually get to an end. And I'm guardedly optimistic that at the end of a process that won't have been pretty to watch, we'll get something that may not correspond to some people's dreams, but will actually be a strong set of initiatives to invest in the future of our country that's more significant than anything we've done in a long time.
Larry, I wonder if you see a possible connection between these two things, inflation on the one hand and what we're doing with climate on the other that you just referred to. In this sense, we saw, for example, natural gas prices really spike up in Europe. We've got problems now in China. Is this something that is really going to stay with us on the inflation front? Because as we convert over to potentially zero greenhouse gases, there's got to be a cost.
I think that's a risk. It's a complicated thing, David, because if you reduce the demand for fossil fuels, that will presumably reduce their price, not increase their price. And that aspect of it will be anti-inflationary. But I think this is something we need to carefully monitor and watch. I think the time frames are somewhat different. The inflation threats are of things becoming a bit unhinged in the next year or two. The climate plans are things that will play out over quite a long time period. But it's absolutely something that we need to pay very close attention to as we set the policies going forward.
Another,
if I could just say, can I just add something on the subject of the tax debate that we're having? I don't think it's going to happen. It would be fantastic, actually, if we were able to place some kind of tax on some kind of fee on fossil fuels, not laid directly at consumers, but placed upstream on the businesses that produce them. I think that would be probably the best public policy there, as the late George Shultz and I advocated several years ago. Beyond that, I do think that one thing Senator Manchin has said is absolutely right, and that is that we should be repealing much of the Trump tax cuts. There is no conceivable reason why we cannot have a 25% corporate tax rate in the United States without damaging competitiveness of U.S. companies. Costs of capital are near zero. It is not cost of capital that is inhibiting investment right now. This is something we surely should be doing. And on that, I am right with Senator Manchin. I'm right with the administration. I hope Senator Sinema, it's not clear exactly where she stands, and she studied all of this very, very carefully, but I hope she will see her way clear to support a carefully measured tax program that raises revenue we surely need from people who surely can afford it, without doing damage to investment.
Larry, finally, there's another item pending up on Capitol Hill. That's this debt ceiling. And everyone seems to agree, Republicans and Democrats, we're never going to default. At the same time, they don't seem to find a way to actually raise the debt ceiling without raising the specter. What do you make of that debate? And maybe as important, Larry, what do you think the rest of the world is thinking as they look at this?
Games of chicken are really dangerous. People who play games of chicken never plan to crash their cars and die, but occasionally they do. And that's the risk in this thing. And I hope people will find a way to recognize reality. There is no magic solution that is going to get us through this. Some 50 people in the Senate and 218 people in the House are going to have to take a vote that they would rather not take, but that there is absolutely no choice for our country to take. And I just hope we'll find a formula where that's done. You're already seeing the effect a bit in the Treasury markets on securities that are coming due soon. The longer this happens, the longer we look like a country that's having difficulty governing itself. And that's an important issue for our international perception. Most important op-ed of the year was written by Robert Kagan in the Washington Post this week, and it discusses how there's a real danger to American democracy from authoritarianism coming out of President Trump and many of his allies. And there is no responsibility, much more important than whether we have this size tax bill or that size tax bill, this inflation rate or that inflation rate, is that responsible officials find ways to marginalize that, I never thought I'd say it in the United States, authoritarian threat.
That certainly puts it all in perspective. Thank you so very much to Larry Summers of Harvard, our very special contributor on Wall Street Week. Coming up, one more thought. Getting investment advice from a small, furry rodent. That's next on Wall Street Week on Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Finally, one more thought. Taking a random walk on a hamster wheel. We spend a lot of our time trying to understand the markets, explain the markets, even predict the markets. And we have no shortage of experts who can tell us what the markets are doing, at least in retrospect.
The bond and equity joint sell-off.
This growing anxiety.
We're trying to read the tea leaves.
People are just closing their eyes and waiting for this all to be worked out.
We basically entered a high volatility regime.
If you've got a 10-year yield at 1.5%,
a steepening in the yield curve.
The Fed has said that they're changing policy.
They've telegraphed the tapering.
Delta fears have caused concerns. All the pressure on Evergrande and Chinese debt markets.
You get volatility.
And now coming out of Germany, we get maybe a useful reminder about just how modest we should be about what we think we know about the markets. Meet Mr. Gox. He is a hamster. And like most hamsters, he spends his days pretty much running on a hamster wheel and running in and out of tubes. But his owner has set it up so that Mr. Gox can trade cryptocurrency. He does it because where Mr. Gox stops on his wheel points to a specific currency. And whether he's on the buy side or the sell side depends on which tube Mr. Gox goes in or out of. And we can all watch Mr. Gox make his investment decisions in real time because it is streamed on Twitch. And of course, Mr. Gox has his own Twitter account as well. And the results? Well, let's put it this way. Since June, Mr. Gox's portfolio of cryptocurrencies is up 16%. If you're keeping score, that's better than Bitcoin, better than the S&P 500. It's even better than Warren Buffett's Berkshire Hathaway. But on the other hand, if you watch carefully that streaming video, you notice something about Mr. Gox. he actually isn't so much a crypto trader as a crypto holder. Because most of the time, Mr. Gox is in his cage, not doing much of anything. He's not on a wheel. He's not going in and out of the tubes. So maybe, in one sense, Mr. Gox is a long-term investor. Does that remind you of anyone? Like, for example, investing icon Warren Buffett?
I'm buying stocks, but I'm not buying them because I think they're going to go up next year. I'm buying them because I think they'll be worth quite a bit more money 10 years or 20 years from now. And I don't know whether they're going to go up or down tomorrow or next week or next month or next year.
So perhaps, maybe the German hamster, Mr. Gox, is one more follower of Ben Graham and Warren Buffett. That does it for Wall Street Week for this week. I'm David Weston. This is Bloomberg. See you next week.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I'm Francine Lacroix, and welcome to Bloomberg's Front Row. Today, I'm talking to Noel Quinn, the chief executive leading HSBC through its most radical overhaul in years. The expectations are high. Noel's predecessor was ousted by a dissatisfied board. Now, this 35-year banking veteran has to show he was the right choice to run the largest bank in Europe, one with a long history in China.
Let's be honest, if you want to be an international bank, serving the world, serving 60 markets, at times it can be difficult. And I'm not going to deny that.
Noel was already making big changes even before clinching the chief executive role. In his first interview since becoming chief, we talked about revamping a 156-year-old institution, his expansion plans for China and beyond, HSBC's green transition, and why he's taking a tough line on crypto. Plus, the enormity of challenges from returning to the office to retaining talent. Here's my conversation with Noel Quinn. So, Noel, you've had quite a busy 2 years. You became chief executive formally. You've had the pandemic. I mean, how has that shaped your strategy for the bank?
Well, clearly the pandemic was a major influence on everything we've been doing over the past year, 18 months. But I want to go back, actually, when I first took over. There wasn't the pandemic. It hadn't taken hold at that time. And we embarked on what I believe is quite an ambitious transformation plan. We committed to sort out some unprofitable businesses that we had. We committed to really releasing those good businesses we had, particularly in Asia, transaction banking, and investing in those. And I'm really pleased with the progress we made. But then the pandemic hit early last year. The health crisis was a global one, as we all know, but led very quickly to an economic crisis. And the most important thing for me is the way our people responded. They were superb.
I mean, it really shows resilience.
Yeah.
Where are we in the strategy revamp? Are we halfway? Is there more to come?
I'm pleased with the progress we've made. If you look at each aspect, I committed to reducing risk-weighted assets in some of our unprofitable businesses. We're 85 billion done after 18 months out of a target of 110. I'm pleased that we delivered significant cost reductions last year. We reported that. We took out nearly about 10,000 headcounts. We reduced the cost base significantly. We're on track for our cost reduction plan. And I also said that I would address the profitability of our retail business in France and our retail business in the US. And as you know, we announced just a few weeks ago that we're selling our retail business in France and our mass retail business in the US. So that's good progress, but there's still more to do.
How difficult is it to position HSBC with these growing tensions between the US and China?
Listen, geopolitics, we've been around for 156 years. We've faced political tensions in that 156-year history. Let's be honest, if you want to be an international bank serving the world, serving 60 markets, at times it can be difficult. And I'm not going to deny that. But our clients tell us they still want us to bank them globally, whether they're consumers wanting to invest elsewhere in the world, their savings, or it's businesses wanting to trade with the world. The demand we've seen over the past, even in a crisis like the one we've just faced, the demand from our customers to serve them globally still exists.
But are authorities asking you to choose between one or the other?
No.
And clients?
No. We have to comply with the laws, the regulations in the markets in which we operate in. That's a complex task. I'm not going to pretend it's easy. But no one's asking us to choose.
You've lived in Hong Kong. Does that help you actually straddle both dimensions?
It helps you understand the markets. When I lived in Hong Kong, I served, over 22 countries, 22 markets. I travelled regularly. I saw the clients. I understand their businesses. I understood the economies. I was frequently in China, but frequently in India. And it gives you that understanding of client need. And at the end of the day, we're a client-led organisation. And if our customers are telling us they want us to bank them globally, they want us to help them navigate the complexity of world trade, then that's what we should do.
Do you think those complexities will get even more complex?
Listen, I can't predict the future. But is it a complex world we live in? Yes. Has it become more complex over the past couple or 3 years? Certainly. But that's when we step up and help clients navigate that complexity. I'm not going to pretend it's easy, but it's rewarding.
You've moved a lot of your executives to Hong Kong. Would you ever move to Hong Kong?
Listen, I've lived in Hong Kong and I loved it. But I'm going to stay in London. But it's right that 3 of my executives, particularly, they're the 3 heads of some of our global businesses, wealth and personal banking, global banking, and commercial banking, are moving to Hong Kong. It's great for them. They get to experience that growth opportunity. Asia is a phenomenal growth opportunity, not just in Asia, but for our clients as they expand globally. And it's great they're experiencing that. And I want them close to the opportunity and close to the growth. But I'm staying in London.
What are your expansion plans in China? Are you hiring?
Yes, we're hiring. We've announced the commitment. We are an initiative called Pinnacle. The plans there are to hire 3,000 extra wealth managers over the next 3 to 4 years. We've already hired 600 of those in the first 9 months of the programme. We're on track for our target for hiring this year, and the initiative's going really well. It's meeting business case expectations.
When we hear China say that actually they want to have a fair society, what does that mean for wealth creation? And what does it mean for your pivot and your focus on China wealth?
Well, let me talk about wealth creation from a China concept. I mean, if you think about the number of cities in China that have over 1 million urban population, there are different statistics out there, but it's certainly around the 75 to 90 mark. Now, many of those cities have gone through urbanisation over the past decade to 15 years. and they're going through GDP per capita growth. And we're starting to see those cities turn into strong consumption markets. And as they develop consumption appetite, typically when they get to GDP in the double digit, $10 to $12 to $13,000 per head, that's when they start to think about wealth products, insurance, wealth management, investment products. And that's where I think the huge opportunity is. And by the way, urbanization hasn't finished. There's still more urbanization to come. So I think we're on a long transformation program within China where the creation of wealth, and it's about definition of wealth, it's not super wealth just, it's wealth for the middle class and it's wealth for the urbanization that's taken place. That's why I think everyone's interested in China as an opportunity for wealth. And don't just think about wealth in China as the super rich. It's also wealth for everybody, and it can be as simple as an insurance policy.
So with the latest crackdowns and extra regulation, you don't really feel like it will veer you off course?
No, I still think it's an important market opportunity, it's an important market need to serve, and it's not going to change our investment plans.
Do you look at China in terms of a 3-year plan, a 5-year plan, or is it more nimble given some of the changes we've seen?
Oh no, you really got to look at China as a minimum as a 5-year plan, and you've got to really, in that 5 years, be laying the foundation stones for the next 5 after that. You don't look at China on a 1 or 2 year or 3 year operating cycle.
Talk to me about Hong Kong, some of the laws that, the sanctions law. If it comes through, what does it mean for the financial sector?
Listen, as an international bank, as I said, we've been around for 156 years. One of the jobs of an international bank is to comply with complex laws and sanctions laws wherever they're implemented. And that complexity has increased. But we'll navigate that as we have done so far, and we'll continue to do so going forward. But you have to stay close. You have to stay close with your clients and with the regulators to understand their requirements and to navigate those complexities. But it's certainly a complex situation at the moment.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now. Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How much do you spend actually thinking about sustainability? We've seen demand for sustainable products increase.
Huge.
But also a lot of questions about whether, financial institutions are greenwashing.
No, it's a huge topic, and I think it became even more urgent through COVID. I think COVID was the wake-up call for so many people, me included, on how fragile the world is to a natural event. And I think the pace of change, the dialogue that's taking place today relative to 18 months ago is much greater on sustainability. So I think it's both a huge opportunity whilst also a huge risk to manage. And by opportunity, let me just clarify what I mean by that. You know, in our 156-year history, we've seen the industrial landscape change dramatically. The commercial landscape, you know, it's unrecognisable. I think in the next 10 years, we're going to see a similar transformation take place in the industrial, technological, and commercial landscape. Why? There are industries today that are carbon heavy. They will need to transform their technology base, their business models, to be fit for a net zero world of 2050. That creates huge opportunity. There's also risk in that transformation. And what I want HSBC to be is at the centre of that transformation, leading that change. And I quantified what that meant back in October of last year when we published our sustainability strategy. I believed, through all the analysis we've done for HSBC, there is an opportunity to finance that transition, to help those customers build new business models. I quantified that at somewhere between 750 billion and $1 trillion over the next 10 years of either investment that's needed to be funded on our balance sheet or through capital markets.
But often we're not talking about the same language. So there's concern that actually, you know, certain funds, certain banks are overstating some of the sustainability impact.
Yeah.
So how do you avoid that?
And that's where we've got to take the reporting. You've got to have transparent and consistent reporting so that the words financing the transition are not just a marketing strapline or a strategic strapline. That people, stakeholders, investors, regulators can decompose that and say, I understand what your balance sheet looks like today. I understand the targets you're setting to work with your clients to finance the transition. And I understand the progress reports that you're issuing every 6 and 12 months through your report and accounts. And in that regard, we're developing, as other banks are, our own reporting methodologies, but we're trying to do it in a way that's consistent. So I also chair a task force of like-minded banks, about 11 of us, who are trying to set a framework of disclosure that if you use the phrase finance the transition or achieve net zero, this is what it means. And there is an architecture of reporting that we put in place that allows the readers of our reports to understand how we're doing that.
How do you expect the return to the office to go?
Listen, my own view on the return to the office is it would be a waste if we didn't learn from the last 18 months. You know, if I think about the future, do I want the future to be the way it was pre-COVID on working environment? And let me explain that in more detail. Over 200,000 of my colleagues, 90% of them work from home. Not everyone could because they had to work in branches or work on trading floors. But a lot work from home. Now, I trusted them last year to run the bank globally in 60 countries, and they did a fantastic job. I'm not going to turn around to them now that COVID's over and say, guys, I no longer trust you to work from home. You know, not all jobs can be done from home. I'm a realist. There are certain roles that have to be performed in premises. Also, offices will always have a place because offices are great environments for learning, for innovation, for collaboration, and from team building. But I don't have to translate that into a statement that says, right, now work in the office 5 days a week doing emails and VCs, when I've just trusted them to do things at home for the last 18 months. So I'm learning, but if you want a label, I'm probably more inclined towards the hybrid model for certain roles.
What segments of banking do you see more talent wars? So I feel like every day we have a story about junior bankers being paid $110,000, $120,000. Chinese quants apparently paying them $300,000.
Yeah, there is clearly a very hot market at the moment, particularly in investment banking, at all levels, not just the junior levels. There's a very hot market at the moment in global markets, in the in the trading businesses. But they go through phases. We're very fortunate in that we have some really top quality individuals that are working for us, but competition for talent is the same as competition for customers. It has always existed and always will.
Do you have to increase your prices?
Your
pay?
I mean, we've always got to adjust. We want to make sure we're paying to market, that we're competitive, and that we're keeping our talent. So we monitor the market pay levels very closely.
Will you or your executives travel less post-pandemic?
Yes, undoubtedly. Again, it's part of the learning curve. It would be a shame if we all went back to the way it was, where we were flying around the world for one-day trips here and two-day trips there. So my expectation is I will probably do fewer, longer trips. My expectation is that will translate into probably a reduction in our travel budget by around about 50%.
Which is quite,
for the bank as a whole.
Quite impressive.
Yes, that's my expectation. Now, at the moment, we're nowhere near spending the balance of the 50%, because there's still so many travel restrictions. But we've learned to live and operate in a very different way. Video conferences worked. I remember one day sitting at home, I travelled the world in a day, talking to clients in different parts of the world. Now, you can't do that forever. You still want to have face-to-face interaction. I'm desperate to to see some of my colleagues in our markets and spend some time with them for a different type of interaction, a more informal interaction.
Talk to me about diversity. So there was a pretty explosive, actually, expose by one of your employees that the media really picked up. Has it changed in any way your thinking?
I mean, I think first and foremost, when that came to our attention, the first thing we did was talk to the individual concerned, understand his concerns and his allegations, and commenced a formal investigation to make sure that we were following up on anything that he raised, and we're in that process. The second thing I'd say, we are absolutely 100% committed to creating a diverse and inclusive culture. You can't be an organisation that operates in 60 countries and not believe in diversity and inclusion. I've remained at this bank for nearly 35 years because I felt as though, as an individual, and we're all different, I felt as though I've worked for people who valued me as an individual. They motivated me, they mentored me, they trained me, they inspired me. If there were times when I was possibly thinking of doing something else, it was when you didn't experience that. So if I enjoyed that and I felt that motivating, then I want that as a leader of this bank for every one of our colleagues. And when somebody says they're not experiencing that, then that hurts. And that's something we've got to address. And I've got to make sure that doesn't happen. So I want a diverse, I want an inclusive organisation, and we will do everything we can to improve. Now, I'm also a realist. I'm not naive. I know there's more we need to do. I know there's more I and my leadership team need to do to make progress on diversity. We've made good progress on gender, but there's more still to do. We've put an awful lot of effort into matters of LGBT. It's clear we haven't done enough for our black colleagues, and they feel as though they haven't had the same opportunities that others. And that's why I set a target that by 2025 I want to double the representation of our black colleagues in our senior leadership ranks. And I want to make further progress on gender diversity. So I've got an agenda that we're working on. I'm committed to it. And I'm not naive to think everything's perfect. And I will make sure that I will keep working on that agenda.
Talking about cryptocurrencies,
yes.
So you were definitely on the very cautious end
yes.
of cryptocurrencies. Has that changed?
No, and let me explain, because it's important to step back.
Yeah.
When I think about cryptos, whatever the form is, I look for two attributes, I look at two dimensions. Firstly, transparency. Secondly, convertibility or volatility. Let me deal with transparency first. Particularly with respect to cryptos, it's important to understand who the counterparties are. And are those counterparties transparent to each other? And are they transparent to the intermediaries like banks and regulators? Because in the world of high expectation on money laundering controls and sanctions control, a lack of transparency can get you into trouble very fast. Second dimension, convertibility or volatility. I look at that from the point of view of, if somebody wants to hold a crypto, what's that cryptocurrency worth? And is that client suitable for that level of volatility? Let me give you an example. If I'm lending money to a corporate and their balance sheet is denominated in US dollars, their sales ledger, their receivables, their cash balances are US dollars, sterling, euros, I'm able to form a reasonable assessment of the value of those assets. Now, if those assets are denominated in a cryptocurrency that can fluctuate plus or minus 10 or 20% in a day or a week, and I've got to make a lending decision, do I lend money to that company? How do I value that balance sheet? So, for me, there are certain types of cryptocurrencies that score highly on transparency and convertibility, and clearly central banked digital currencies score highly on that. There are other types of cryptocurrencies that don't.
Bitcoin.
I'm not going to name any one of them, but I'm looking at it at a theoretical point of view.
Yes.
And then there are certain clients that can cope with volatility, and there are certain clients where I'd have a conduct issue if I encourage them into volatility. So I looked at cryptocurrencies and say it's a phenomenon for the future. It is there. It's happening. So I can't deny it. But equally, I've got to assess the risks and the proposition to clients and different types of clients. And therefore, I am more cautious at this point in time because I've got those two lenses that are absolutely critical.
Do clients want them, though?
Yes, of course they do. No, not all clients.
So are you missing
clients.
out on business?
Yeah, but that's life. You know, at the end of the day, you don't, as a financial institution, you can't chase every piece of business that's going if you don't think it's the right piece of business. Just because a market is evolving in a certain way, you've got to make judgment calls as to which business you'll go for and which business you may not. I firmly believe that central bank digital currencies are going to be there for the future, and I want to be part of that part of the market. I think there are certain forms of stablecoin that equally can exist very well. But I think we've got to see how the market evolves, but I look at those two lenses, and they're important lenses, because if you get either one of those wrong, you've got a conduct issue on client conduct, or you have a credit issue in that you've lent on the back of an asset base that is not real, or you've got a financial crime issue.
So through those two lenses, what needs to change for you to change perspective?
Well, I don't think I'll ever do anything that is involved in a lack of transparency, because you cannot be true to your commitments to regulators to operate a compliant financial crime environment, a compliance environment, if there is a lack of transparency on a transaction. You know, I can't move money around the world, hard currency around the world, without understanding counterparty risk. No international bank can. You put your license at risk. So why would I then do it in cryptocurrencies just because it's an emerging opportunity? Why would I do in the crypto world what I won't do in the real world, in the hard currency world?
Noel Quinn, thank you so much for your time.
Pleasure. Thank you, Francine.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
We didn't want our story to be ended by Taliban. We wanted to continue the path that we started, to continue to go for our achievements and to go for having our dreams to reality. So that's why we decided to leave Afghanistan and go for somewhere safe. We are concerned that what will happen to our home then. Many people are leaving, but there are still girls who have dreams, there are still people who have dreams, and we want countries around the world to help Afghanistan to have peace over there, so that the girls over there can have the opportunities to continue their path as well.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think that SPACs are very much here to stay.
You can trade anything as a trend follower.
When you think about Bitcoin, I don't think it's a currency, I think it's a commodity.
Today, we're in an everything bubble.
I'm Eric Schatzker, and welcome to Bloomberg's Front Row. Today, I'm talking to the hedge fund hotshots who founded Diameter Capital, Scott Goodwin and Jonathan Lewinson. They invest in credit, everything from investment grade to distressed, making bets on whether borrowers will or won't repay their debts. Diameter is a new breed of hedge fund built for modern markets where speed is the difference between winning and losing.
If you look at how Tiger's disrupting venture with, frankly, speed of capital, or what's happening with Owl Rock disrupting private credit at speed of capital.
Speed of capital is really what matters. You don't have time anymore in an environment to sit for weeks and think about it.
Diameter is growing fast too, from $0 to $9 billion in just 4 years. Scott, Jonathan, and I discuss why they're returning some hedge fund capital to clients, how they've produced some of the best returns in credit, a business plan that gets Diameter to $30 billion, the key themes behind their trades, including ESG. Here's my conversation with Scott Goodwin and Jonathan Lewinson. You guys have built one of the hottest hedge fund businesses on the planet, and you've done it in credit, right? At a time of historically low yields, fleeting distress, zombie borrowers, all in the space of 4 years. How?
Well, I guess that goes back to 2010 when we first met at Anchorage Capital. We worked together beneath Tony Davis and Kevin Ulrich and Dan Allen, who ran the firm. John's background is in research and restructuring, mine's in risk and trading. I think we quickly realized working together that combination of risk and trading and research and restructuring worked really well together versus his background in research and my background at Solomon City in just trading and risk. It was very powerful. And eventually we got to the point where we thought we could do our own thing. He had a little interlude at a different firm. But when I left Anchorage in 2016, we were ready to do it.
What we learned day one is we have very different skills. And we're in an environment where more and more everyone wants to say, you just do this. You do a narrow thing. And what Scott and I love to do is we love to look across the entire credit spectrum, from investment grade to new issue, stressed and distressed. And I come from a place where we tend to do lots of deep value work, thinking about restructuring. Scott came from a place where maybe you held positions shorter. And we realized that, and this is the pitch to investors that got us in business, that there weren't many firms, there are many great firms that do aspects of this, but there weren't a lot of firms that were offering investors a investment in credit. Some years it's investment grade, sometimes it's new issue, other times it's shorting, other times it's restructuring and taking over companies in one package that was large enough to be relevant to banks and advisors, but also small enough to be nimble. And that trading and research, by the way, the personalities don't always work. Sometimes traders and analysts don't like each other. We like each other. I think our pants are even the same color today. That was a key part of it, but offering that trading and research together has allowed us to not only pitch something that worked to LPs, but then make it a reality.
If I had gone to your clients, whether they're institutions, whether they're high net worth people, whatever, back in 2017, and asked them what they thought, I know what they would have told me. They would have said the last thing the world needs is another credit hedge fund.
Yeah. They did. In fact, the joke we made was the world would rather have I think a global epidemic, we said, than a credit hedge fund. So we should probably retire that now. But yeah, but that's what kind of made it work. What we're doing is a little bit of a throwback. We believe that there are inefficiencies in markets, in trading, and that if you are able to be native across these markets, you'll be able to more quickly understand where the dislocations are. And so in pitching that a little bit of a throwback and pitching a hedge fund, which in many ways was a dirty word. Today we manage a number of different products, but saying we're going to do that. We're going to provide you something that is not as volatile as the markets and that is more smooth. And in down markets, hopefully we do well. Was something they hadn't heard in a while, and we're lucky that some people took a chance.
Maybe we're a little bit more proactive and aggressive in terms of getting research done ahead of events versus reacting to the event and doing the research after the event. But it's combining that trading and research with speed, which we think speed is really alpha in credit. You have a discontinuous market structure. So how do you engage in a discontinuous market structure with speed? You have to know a lot of names. So we have a 20-person analyst team here that many of whom have worked with us previously that help us know a lot of names. And if we know a lot of names and we combine the risk and portfolio management functions, which is what we've done, and that I do a lot of the trading as well, then we can react quickly when a mutual fund needs to sell a block of bonds. Because Fidelity or BlackRock or PIMCO, the big mutual fund complexes, if they might have an outflow and they want to sell, the banks are no longer bidding on a couple $100 million bonds. They're calling us or maybe one or two other counterparties that can react in 5 minutes because we have a proactive process where the research is done up front and we know the names. We can respond in seconds. We don't have to go through the junior trader, then the senior trader, then the junior analyst, then the senior analyst, the junior PM, the senior PM, layers and layers and layers and layers and layers of frankly bullshit, pardon my French, to make that decision. We can make it fast.
This is a new firm. We only started investing on September 1st, 2017. We have the benefit of taking our skill set and our team's skill set and kind of molding it for the current environment, for the current state of credit markets, for the post-Volcker world, and for the world now post-COVID. Part of what we think separates us from many of our competitors, even though many of them are great, is this combination of knowledge and speed. Speed of capital is really what matters. You don't have time anymore in an environment to sit for weeks and think about it. And in some degrees, you see private equity firms oftentimes wanting to get into credit when it's interesting. But their cultures are set up to be slow because they swing infrequently, and it doesn't always work. We've set up a culture that says, do your work ahead of time. Have a huge amount of work in the preparedness and less amount of process in the decision making. And that, we think, works with our skills, but also is designed for today's markets and really builds on what we've learned from many people who have come before us.
If you look at how Tiger's disrupting venture with, frankly, speed of capital, or what's happening with Owl Rock disrupting private credit at speed of capital. So all these markets that have discontinuous liquidity, speed of capital matters because most people provide slower capital. If you can provide speed of capital with knowledge, not just provide speed of capital without the research, then you can have an advantage in an environment that's highly competitive.
Now you're returning some of your capital to clients and you're raising fees. How come?
So we'd always size constrain it. We'd close multiple times. We were actually closed when COVID started and we reopened and took money in. But now we're going to return about 10% of the capital at the end of the year, which will bring the fund into the $5 and change billion range from the mid-sixes. And we think that that sets us up to grow into that capital base again. And if it happens again in the year where the market environment hasn't changed, we'll return capital again. We want to size capital to maximize returns on a risk-adjusted basis. That's something we've committed to our day one LPs. And in terms of the fees, we want to be competitive. We need a lot of people to run our strategy. And we're competing with people who have, frankly, much larger businesses.
Our business, certain of our strategies just don't work if you have to make massive investments all the time. And this idea, when we want people to think about diameter, we want you to think about big enough to be relevant, small enough to be nimble. And the second we feel that nimbleness is compromised, we're not running the strategy that we want to run. It becomes someone else's strategy, and frankly, we wouldn't be as good at it. We have tests that we use, and like anything, it's quantitative and qualitative. Can we move 1% position quickly, long and short? Can we, partnering with banks and issuers on new issue is an important part of our business that we can get into. We don't like using leverage, and so we like doing a lot of new issue in bull markets. Can we get enough of that for the fund size?
Bloomberg surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
you look
drop
great.
The bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
Any mistakes you've made or failures that you can talk about so that people could feel you're not just a superhuman?
People ask that question as if the only challenge is at work. Challenges come in a lot of different packages.
Some people I know are baffled by your returns. They say there's nowhere near enough ways in credit today to generate that much alpha, especially running as little leverage as you do. So what's the secret? How does the magic happen?
So, I mean, it's knowing the names first, right?
You really believe that is, well, that's a dividing line between you and others?
Everybody can know the names, okay?
But no, not everyone does.
But knowing them early and knowing a lot of them versus knowing them after they go down. Think about it. Most of credit is rules-based. You have investors who either have a ratings constraint, a duration constraint, or a liquidity constraint.
Mutual funds, for example.
Mutual funds, others, CLOs, right? We manage CLOs. They have tons of constraints on them, and we abide by those constraints. But if you have a universe of names you know, And then you can apply that to all markets, investment grade, levered loans, high yield, stress, distress, structured credit at any given time. In 2011, it was Meredith Whitney blowing up the muni market, right? And be agnostic to where you go on a risk-adjusted basis and be fast because you have a trading mentality that is in your portfolio management process. That's what differentiates it. And it's in this environment, like people are going to say again, there's nothing to do in credit, right? Diameter's returning capital, but there is stuff to do. We just think we want to size our core hedge fund product to do it well. What is there to do right now? Well, you had a pandemic, huge recession. A lot of companies did very poorly for 6 to 12 months. Now they're doing well. Some are having record earnings. Enterprise values are higher than they were pre-COVID. Those companies that were junked are going back to investment grade. There's an arb because when you go from double B to triple B, the number of buyers, the universe expands exponentially. So if you own the company as double B and you think that S&P or Moody's is going to upgrade it, like Netflix is a position for us right now that we think will get upgraded, there are going to be more buyers of Netflix and those bonds will tighten. And maybe that isn't a money multiple opportunity, but it's a high Sharpe, high IRR opportunity. Capital markets. There's record M&A right now. We have capital markets bankers calling us asking to lay off risk because they want to do more deals. So A, we can help them lay off that risk. We can participate in those deals, learn new names. Those are the opportunities, and credit dispersion was record lows first half of the year. Now it's starting to come back.
You looked skeptically when we said know the names. Why can't everyone know the names? It's an efficient market. You can't, think tanks don't work in finance. By the way, I don't know that they work that well in Washington, but that's again another story. Think tanks don't work here. So if you don't have a mandate to buy investment grade bonds or to buy new issue high yield bonds, you are not going to know them. If you don't have a mandate that includes shorting businesses occasionally, you're not going to know businesses that are in the decline. So when the crisis hits, whether it's oil and gas collapsing in 2014 or 15, or it's even at the end of 18, when there was a scare on interest rates and the market sold off, or of course the global pandemic that we went through. If you haven't invested in the names previously, you're not going to do it again, because what do people do? When you are afraid, when the market sells down, unless you're a total psycho, unless you're the guy in free solo whose brain is different than the rest of us, you're going to be afraid too, right? Because the market is trading off for a real reason. There is a global pandemic, okay? So you're not going to buy something you've never heard of. You're going to go back to what you know. But if you've only been looking at crappy companies, let's say that's your mandate, then you'll buy things that went from 75 to 50. We think oftentimes they go to 0. So it's our mandate of always looking at a lot of things, not having a think tank, always finding ways to invest in it with one team that allows us to constantly find what Scott talked about, the return available in credit.
What are you 3 years from now, 5 years from now?
Hedge fund, 5 to 7 billion. CDOs, $1 billion to $1.5 billion. Because there's a cannibalization effect there with the hedge fund, so we size constrain that business. CLOs in the U.S., 8 to 10. CLOs in the U.S., in Europe, maybe 2 to 3. Structured credit, long-only business potentially, that's a couple billion. And then we think about what's happening in markets, and we want to adapt our business. And we think that eventually private credit's a business that we'll be in. I'm not going to put a size on it. But we see what the private equity guys are doing. We're getting more and more calls from them, especially on second liens, where we've worked a lot with Thoma Bravo, for instance, to originate a second lien paper with them. We think that there's a real convergence in the credit space that we focus on, not the really small cap stuff, but mid and large cap, where we'll have an opportunity to be in that business as a complementary business to what we're doing elsewhere.
If I add all those numbers up together, it's big. I get to north of 20, maybe 25.
Yeah, 30, maybe. Yeah, we'll see. But you're only as good as your last trade. We got to keep making money in our core products first, and the other stuff will come along.
4.5 years ago, we were in a windowless room. We remember that every single day.
Have you thought out a strategy yet for private credit?
Whether we do it in a small scale or a large scale, we're still discussing, but it's a business that you'll see us in over the next few years because it's really synergistic with what we're doing, and we want to provide those capital solutions when companies come to us and they say, well, we want a private and a public solution. We want to be able to provide that, whether it's working with the banks or working with the private equity sponsors that we do a lot of business with.
And we want to know more names. And so it's not something that was on the page, though, to your point. 5 years ago in Bubbies, we're not thinking that way. The market is changing, that dynamic is changing. CLOs are growing like crazy, so there's people need public paper too. But that's why we're thinking about it.
You have to adapt. You have to be nimble. And the market's telling us right now that that's a business that we eventually need to be in.
I want to ask you about regulatory issues. Gary Gensler, the SEC chairman, is turning his withering gaze on corporate bond trading. He told senators he wants more efficiency and he wants more transparency in what historically has been an illiquid and opaque market. What could he do?
That to make the credit market look a lot more like the equity market would be a massive, massive overhaul. Doesn't mean that you can't do things to bring it closer and to protect investors who are today not being appropriately protected to the extent that exists. But I think it also highlights a really important difference. Scott mentioned it earlier. Credit investors are generally rule-based investors. You're looking at what's the rating, what's the industry, what's the geography. And certainly there are rules-based investors in equities to some degree, but it's such a different product. Equity markets forcing you to think so much forward-looking, whereas credit markets oftentimes are thinking, what were the last 12 months' earnings? That there are probably really good ways to reform credit, many of which we haven't even thought of, that don't necessarily say just copy what you see in equities.
You go long and short in the hedge fund. Mm-hmm. Do you think of shorting as a hedge or a source of alpha?
Shorting is controversial. My dad was an equity research analyst. And he used to say to me that shorting is un-American to some degree. He's an investor in the hedge fund now, so maybe he's come around. But we really believe that so much time, so much on television, is thinking about who are the winners, right? Who's going to have the best payment app? Who's going to have the best electronic vehicle? And a big part of what we offer investors in thinking about shorting is sometimes finding the losers is easier. And finding them before it happens in capital structures that are hard to move around. And so we really think that building our business to think about where is there technological transformation, where is there policy volatility, and where is there a lot of debt? First it was oil and gas led in terms of debt, then healthcare led in terms of debt. Now I think it's technology that learns in terms of issuance. Basing our business around that to learn those companies not only produces a return shorting, but we turn around a lot of times and then buy them later when they're at a lower dollar price and help fix the businesses or work with people to fix the business.
We've had too many shorts the past year. It's certainly been a drag on our returns. Our drawdown fund, which is long only, has done much better than our hedge fund. But we're starting to see price volatility come back, and maturities change things. So there are certain sectors we think, like airlines, have been zombified by what's happened over the past year with all the bailouts there. And some of those capital structures over time will have problems. There's nothing obvious right now. But you have to, when you're shorting, what are you playing for? Are you playing for a downgrade, earnings miss, a default, right? You have to know what you're playing for and size your position to be able to trade it accordingly. But right now, you're not playing for a lot of defaults. And we don't have a ton of shorts right now, and they're very concentrated in the industries and sectors that we think have been more zombified by COVID.
You believe in shorting. It's part of the capital market, right?
Yeah, sure.
Do you worry at all that the meme stock vigilantes could turn on credit players like Diameter and make you pay a Melvin-like price for having negative views?
It was something that no one thought could happen. It happened. And so we've now thought about it deeply and are more worried than we were.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
What are some of the big themes informing and underlying your trades right now?
The world is dealing with huge questions, but they're much longer term with a much broader array of outcomes. We're now learning that COVID is probably going to be something that is going to be with us in some form. We're learning that the vaccine efficacy changes over time, and you may need boosters or not. We are seeing that China is upsetting a lot of the expectation in markets as it changes some of its approach from economics to politics. We're seeing our politics at home. We may have a rerun of the 2020 election in 2024. And we have a central bank that has been really arguing since June to think about quantitative easing and rates and inflation differently. The problem is you don't get quick answers. Last year was unique. We got quick answers. All of those play out over 18 to 24 months. And I didn't even mention the fact that what happens to stimulus that the market is really addicted to if, for example, the control of the Senate changes in 2022. So what we think that leads to is a more tactical market, harder to sit there and say, I believe this. Also, 2 years of COVID, there may never be a new normal in terms of work from home and business travel. And so we're spending a lot of our time, looking at economic data. We're not macro traders or investors, but everything we do starts in what is the macro of the economy? What is the macro of the industry? What do we think about different types of consumers? How is spending going to change? Where is pricing going to really affect? And a lot of the themes we're focused on are how much of the inflation in goods is transitory versus real? We think generally that over time supply chains work themselves out, but that services inflation is much harder to give back because once you've raised wages, it's harder to go back. And so some of those themes, which we then apply to industries like airlines and commercial real estate and hotels, where we see paper available and see some distressed, that's how we go from that 30,000-foot macro down to the company, but it always has to start with a view on the economy.
Many in the markets are terrified by the prospect of a taper tantrum. Are you?
Oh, I'd love it. I mean, we might lose money at the beginning of it, but we have our watch list, we have our process. Each analyst is ready. We're disappointed there hasn't been one yet. And I think that would be a great opportunity for us.
Because?
Because what we'd rather do than do distressed or grind out returns in Netflix, getting upgraded, frankly, is buy really good performing risk at a discount to par. And taper tantrums, 2013, created an opportunity like that. It was there for maybe 3 to 4 weeks, and it was gone. We really like those opportunities. You had a loan market type tantrum when the Fed changed its policy at the end of 2018. Loans went down 5 points. We put 15% of the fund in loans in like 2 weeks. So we'd be excited for that opportunity set. But again, people have been predicting that all year, and it hasn't happened. Yeah. So positioning for it, are you going to be positioned exactly right for it? No. And then you have to be able to change. So what does being able to change mean? We better run a low gross right now, which we are. Our gross is close to as low as it's been. We don't run a lot of gross because we have more trading velocity, and especially periods like now. We're sitting and being more patient. We're not patient people, but now it's kind of a time for patience.
Scott's excitement jumping off the page there goes a little bit to where we're different. So if you think about a taper tantrum, you're saying high quality bonds trade down. They don't go to distress levels. They go from par to 90, from 98 to 88. That would be an environment where big distressed guys would not be interested yet because these companies aren't defaulting. They're down for technical reasons. And they would look at the yield and they say, well, this doesn't hit my yield bogey. Whereas performing credit people might be having outflows because the retail market might react and say, oh, wow, bonds are going down, I want out. There are not a lot of, we've set up the firm to be at that intersection, to be able to buy the highest quality stuff when it's down, and that's represented by a taper tantrum.
You've committed to not invest in thermal coal, guns, and tobacco.
Yeah, no longs.
Why?
I mean, we're trying to respond to our investor base, which is, frankly, I think ahead of the curve versus the hedge fund industry on ESG. And we've got some really thoughtful investors that we're working with, not only in the hedge fund and the drawdown fund, but in our CLOs, which have even more stringent ESG policies so far than the hedge fund does. We don't think that we should be supporting and financing companies that have negative long-term impacts on society. And ESG is really interesting because it's probably going to be something that changes cost of capital for companies for the next 10 years. It's going to be a huge changer of cost of capital.
We'd love to say this is just driven by our moral ideals. It plays a role. But as Scott pointed out, the market is no longer going to provide capital to restructure these businesses. The number of regular way investors, particularly investors higher up in capital structures who don't want to take a lot of risk, they want to be able to say, I'm not taking a lot of risk, I don't have a lot of return, so God help me if I'm helping a company that's destroying the environment or doing bad things to people. So we think that we're getting a little bit, trying to get a little ahead and saying, not only do we want to do the right thing, but the cost of capital is going to change dramatically for these businesses, and don't think about your old valuations when you think about some of these dirty companies.
And we're going to have to make our money shorting them because we're not going to be investing in the distressed when they go distressed.
But you're in the money-making business, right? As the cost of capital rises, the return to the investor in that issue, whether it be equity or whether
it keeps rising, right, keeps getting worse. A lot of the thermal coal, in many ways, people tried. They said, oh wow, look how cheap this is. Right? And then they realized there's just a whole generation of people who don't want anything to do with it. You're going through in Europe a little bit of an issue with power right now, and coal plants are slated to close in the UK, and you don't see a huge uprising and say, what are we doing? The world has moved on a little bit. You can assume maybe that the cost of capital might change and go back down for some businesses, but for others we think it's a rise upward.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Watching the best of Bloomberg Daybreak Middle East, the major stories driving the headlines this week. Sources tell Bloomberg that the UAE's de facto leader was among Emirati officials who directed billionaire Tom Barrack's alleged campaign to influence the foreign policy positions of the Trump administration. As Brent crude hits a 3-year high this week, OPEC says it sees oil demand continuing to grow in the middle of the decade. Here, our interview with the Secretary General, Mohammed Barkinder. And Saudi's Aqua Power sets the offer price for its IPO at the top of the range, highlighting the demand for the share sales in the kingdom. First up, we had a Bloomberg scoop breaking during the show on Tuesday morning. Sources had told our colleagues that the UAE's de facto ruler, Crown Prince Sheikh Mohammed bin Zayed Al Nahyan, was among the Emirati officials who directed billionaire Tom Barrack's alleged campaign of influence the foreign policy of the Trump administration. Well, we've got more with our U.S. legal reporter, David Vorekos.
Well, the federal prosecutors charged that 4 of those 5 officials tasked Barrick and its co-defendants with pushing the UAE's interests in the U.S. And specifically, it claims that Barrick was part of a secret back-channel effort to influence the foreign policy positions of the Trump campaign and his incoming administration in 2016 and 2017, and to increase the UAE's political clout.
Now, part of the breakthrough here from this Bloomberg story is around a bit of an identification around who these 5 officials are and sort of the significance in the broader case.
Well, as you said, the UAE's de facto leader, known as NBZ, is one of them. His brother, Sheikh Tahnoon, as well as Ali Mohammed Hamad al-Shamsi, who's the director of the intelligence service, Abdullah Khalifa al-Ghafli, who's overseen the UAE's humanitarian efforts in Pakistan, and Yusuf al-Otaiba, who's the UAE ambassador to the U.S. Those first 4, according to the prosecutors, are the one who essentially told Barrick and its co-defendants how to carry out UAE's interests in the U.S. And Barrick is accused of doing this without registering first with the Attorney General in the United States.
I suppose this begs the question then, will these UAE officials be charged with any crimes?
No, under U.S. law, they can't be charged with any crime in this type of case. And the prosecutors have to prove that Barrick acted under their direction and control. In his defense, Barrick will likely argue that any positions he advocated to the Trump campaign and the administration were his own beliefs and not those of the UAE's top leaders.
Investcorp Holdings, which is one of the largest foreign buyers of U.S. real estate, says it's bullish on the world's biggest economy. The chief executive and chairman, Mohammed Al-Adi, expects the crisis enveloping China Evergrande to offer fresh opportunities as it seeks to expand in Asia. I spoke to him on Sunday.
I think it's not a Lehman moment for sure for China. I think the Chinese government have a lot of tools to deal with this if they decided to do that. First of all, we have no direct investment into the real estate there, so that's important to say. Look, I mean, in the 40 years that we have been working in the U.S. and Europe and the Gulf, and we've seen a lot of crises like this, and China has seen a lot of crises like this, and the United States has seen a lot of crises like this. I think this is something that is temporary, that contained within China and Asia. And actually may have like a calming effect on the prices of real estate that are really ballooning in parts of China.
In moments like this, as you say, maybe they can take some of the excess out of the property market. You say that you've got no direct exposure. Could you see yourself, if the opportunity arose, sufficiently discounted to take direct property exposure in China?
Of course, yeah, of course. We're there for the opportunities. We're there for the long term. Obviously, the sectors that we have focused on at the moment are what we see is the best sectors that we focus on: technology, healthcare, and the food business.
So those are the big opportunities. Can we just broaden the conversation out? I set the agenda this morning at the start of the show talking about the timeline to taper in the Federal Reserve. The Bank of England has shifted a little bit in the past couple of days. The Fed has set out some kind of a timeline on taper. You've lived through many tapers and many market moments. How do you assess the ability to deal with this taper from the Fed on this occasion? Will there be a risk of a taper tantrum? How do you assess the Fed?
I mean, I think the Fed has been very careful about this right from the beginning, and I think the entrepreneurial thinking that is there in the whole of the American economy is very, very important. We expect some of the tapering to happen maybe in the fourth quarter of this year and continue. But I think it will be gradual. I think the Fed will also have an opportunity to discuss their average inflation policy going forward, which has again an effect on not to creating volatility. We're very bullish on the U.S. economy. We know all what's happening in the world may be dampening to growth, but we see a good growth coming.
So very bullish on the U.S. economy. Will you seek to do, I know you have a technology fund that you've raised some funds for. Will you seek any new funds? Can you tell me anything coming down the pike in the next 6 months? Anything that's in the offing?
So, I mean, some of the fundraising or some of the structures I can't talk about because of regulatory business. But we have our North America PE fund that is over $1 billion. We've reached $1 billion. We have a real estate vehicle coming online. In Europe, we have another vehicle that we're working on. So absolutely, I mean, that continues.
You're one of the biggest buyers of North American real estate based from here in the Gulf. Everybody'd like to know your view. I mean, you're all in on America. It's your number one spot and you're very bullish. Are you as bullish on the property market there? And are there any risks in commercial property given the work from home scenario? Just lay out your view on U.S. commercial property for our viewers.
So we are in the top 5 foreign investors in American real estate. We've been doing that for a long time. Our investors have been happy with us. We give them very good returns, I think 18% IRR in the last 10 years. We have, in 2014, we said we will focus on the sectors that we think are resilient to crisis and cycles, and so those sectors were the multifamily and the industrial. And in those two, we still see strong fundamentals, a lot of capital going into them, good growth of rent, good occupancy, resilient during COVID, and we continue to do more of that. I think that's also is helped by the behavior, the change in behavior of customers, supply chains changes, and the need for more warehousing, not just in big cities, but even in small cities.
So that certainly could provide the opportunities. I know that you run hedge fund, you have hedge fund businesses as well. Just let's close off the conversation in terms of flow and risk in the hedge fund business. What can you tell us there? Lots of people come in here or come on Zoom and say, peak markets, peak growth, peak risk, sort of Damocles on markets. Are you drinking from that cup? Are you in meltdown kind of risk? Concern? Give me your global concern at the moment on markets.
Well, I think the bounce back after COVID has really helped all businesses, and I think the volatility that has happened has caused some opportunities for hedge funds. Obviously, we have a joint venture with InvestCorp and Tages. Where we came together. They do things in Europe that we don't do. We do things in the US that they don't do. And it has been really a collaboration of covering most of the strategies and tools in the hedge fund. And so far, so good.
Up next, Saudi Arabia's ACWA Power sets the offer price for its IPO at the top of the range, highlighting the demand for the sale of the shares in the kingdom. The details right here on Bloomberg.
Ireland dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that of course is not disconnected from the energy agenda, and there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
Welcome back to the best of Daybreak Middle East. Aqua Power is one of Saudi Arabia's main vehicles for building renewables energy projects. It set the offer price for its public offering at the top of the range. That's as investors flock to the share sales in the kingdom. It will raise $1.2 billion for Aqua and value the company at $10.9 billion. We got more with Fahad Iqbal, the head of the private bank for the Middle East research team at Credit Suisse.
That's something which we've been concerned about for some time. That valuations are getting a bit rich. But I think what's important is that, rich valuations can persist as long as you've got underlying growth and you've got underlying sentiment and appetite. So they can persist. The concern would be if we start getting into bubble territory valuations, which doesn't seem to be the case at all for the time being. It's not entirely surprising that we're seeing such a huge amount of flow going into Aqua Power. And that they're pricing at the top of the range. There has been a dearth of investment of IPOs in the region for a while, and there's clearly a huge amount of liquidity and appetite. So it'll be good to see all of this being soaked up. What we tend to be a little bit concerned with IPOs in the region is that these IPO numbers tend to be inflated by investors who are looking to make that very quick one-day buck on the opening itself. And that leads to a huge amplification of what the actual underlying demand is. Yeah. But aside from that, the track record on IPOs has so far been, been very robust.
I mean, Saudi Arabia has been pushing the envelope a little bit in terms of trying to make progress around the green transition and establishing ESG standards and benchmarks. Now they're building as well a factory for EV battery components, for example. It's one of the news items that came through overnight. I'm wondering whether you focus on that opportunity now, or you say, you know what, it's okay to have a portion of our portfolio of exposure to fossil fuel, themes because of high returns.
You make a very fair point. I mean, I know if you look at US and Europe, there's a huge amount of focus coming on ESG. And increasingly, investors are saying we don't actually want to be associated with non-ESG compliant investments. That really isn't the case in APAC. It isn't the case in the Middle East either. There's definitely a recognition that this is a theme which has fantastic secular growth, but it's not an exclusive theme. So I think, especially when you look at the Middle East, there is continued focus on the old school fossil fuel industry. And what it boils down to is a recognition of the fact that despite the transition that is occurring globally and in the Middle East, there is going to continue to be growth in the fossil fuel industry. As you said, there's going to be returns there. And as long as that's the case, you will always find at least a portion of investments going into that segment.
One of the things that we've been talking on the show about much is around what to do with oil prices. Brent close to $80 a barrel. Saudi Aramco is trading substantively higher, in fact, the highest since its IPO. Do you add to some of the petrochemical names, or do you say, you know what, we're actually a bit more careful here, and we stick with some of the super themes for Credit Suisse, like infrastructure?
Yeah, absolutely. I mean, that is essentially what we would say. It's certainly not a moment for us to be adding to that exposure. We're a little bit concerned over the near-term risk-reward payoff for oil and petrochemicals in general. I mean, okay, I say near term, over the next few weeks, maybe even a couple of months, yes, this momentum in oil can persist. We can see oil crossing the 85 mark, maybe even touching the $90 mark. But a lot of what's happening with oil is going to be dependent on what OPEC Plus does, and they are not going to want to see oil returning to that $100 plus environment because it's demand destructive.
Yeah.
And then if you take a slightly longer term view on the 6-month, 12-month horizon, the inventory story is a lot less supportive than it has been thus far. So for us, the risk-reward payoff is really not as exciting in oil. Near term, I think you can stick with these oil energy exposures, but it should be more about timing the point at which you sell down your exposure rather than looking at when we should be adding to it.
And then for the rest of the region outside of Saudi Arabia, you're still overweight on the UAE, you're accumulating Qatar, and you're still, I guess, holding on to Egypt. Is that right?
We are. I mean, it's been a painful ride, as I'm sure you've seen. And we've said quite adamantly that this is not a market where, over the past couple of months, that you're going to see strong returns. There are near-term pressures to contend with. But as we head into Q4 and Q1 next year, that's when we think a decent cyclical rebound could be timed. And if it doesn't occur, then that's the point where you have to kind of cut your losses. But we think that there is definitely scope for that to occur. The risk-reward payoff for us is still better off in T-bills, even though the T-bill returns are now less attractive than they were before, but they're not in of itself a bad opportunity. But equities for us, this is the kind of the last leg where we expect to see the story pick up and take off.
And then UAE or Qatar, I mean, if you had a preference of the two, because both have strong thematic plays that are coming up, but one is Expo and the other one is the World Cup, or do you just allocate equally?
We wouldn't be allocating equally necessarily. Certainly we see better near-term upside for UAE, especially Dubai, where valuations are better, where that cyclical upturn is just so much stronger. But we've stressed before, and I'll say it again, that once the Expo ends, we have some concerns over how much that momentum can sustain rather. For sure, we're not looking for things to go back to the lows they were before, but some consolidation would be likely and would be due. Whereas with Qatar, you've got a multi-year story building up now. And we're in fact, at an extremely early stage. We haven't even seen the LNG capacity increase being actioned upon and being, you haven't seen the borrowings pick up, you haven't seen the expenditure being undertaken. So that's something which will play out over a multi-year period. So as a longer-term holding, there's a lot of promise in Qatar.
Up next, the OPEC Secretary General on why he sees oil demand continuing to grow into the middle of the next decade. Our interview with Mohammed Barkindo. It's right ahead on Daybreak Middle East. This is Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the best of Daybreak Middle East. Crude oil hit a 3-year high this week. It punched above $80 a barrel, and that was before it fell back as part of a wider market sell-off. At the same time, OPEC said that it sees oil demand continuing to grow into the middle of the next decade, and that global fuel consumption will fully recover from its pandemic slump by 2023. I caught up with the Secretary General for OPEC, Mohammed Barkinder.
The worst is over for this pandemic, that we have passed the peak, if you like, in your own words, and that the recovery will continue. It may be slow, it may be bumpy, but we are on the path of this positive trajectory.
So can I ask you then, the WOO that you've released today says that we won't need as much oil from OPEC as we did in 2019 until 2026. So is it correct to assume that between now and 2026, you're still going to have restraint and cuts?
The World Oil Outlook 2021, which we just unveiled today, is the first outlook released by any reputable institution. We have taken the first step, and we are positive in this outlook in terms of demand. Demand will continue to grow till 2045. This world is and will remain very thirsty for the consumption of energy. We are projecting 28% growth in energy between now to 2045, and on good reason. Manus, the world population is going to grow by about 20%. Nearly 1.7 billion people will come into this world. And we have also projected to you that the global economy will more than double between now and 2045. And we believe that going into COP26, that energy poverty will be brought back on the front burner together with climate. And therefore, the world will double its efforts in achieving the SDG 7, which the United Nations has resolved several years ago.
The gas markets, natural gas in the US and the UK and Asia is roaring higher. What scale of crisis, how would you describe the gas market? Are we in crisis?
Well, I know the volatility that we are currently witnessing is on the high side. And this volatility is largely being driven by factors outside the control of OPEC, as well as the OPEC and non-OPEC in the Declaration of Cooperation, and hence the need for this global dialogue to be all-inclusive, particularly with regards to the energy transition. The volatility that you are seeing in gas is also visible in the oil market, and we are.
Do you think that the gas crisis, as people are calling it, is going to boost oil demand? I'm seeing numbers like 500,000 barrels per day next quarter. Do you agree with that assessment?
We, in our projections in the short term, continue to see demand growing progressively as countries open up from the COVID restrictions and encumbrances, as travels open, as more planes fly, as the restrictions between countries are eased. There is no doubt that the large contraction that we saw in demand last year will not likely to materialize. We are on an upswing of the demand recovery, and the concern now is how together both producers and consumers going into this transition will come back to the fundamentals, to the basics. That no single.
In general, that the gas situation, I just want to finish off with this. Do you think, how do we alleviate, what can alleviate the gas spike. Do you think that Nord Stream 2 coming online will help?
It is generally a function of supply. And you cannot even attribute that to one single supply source. I know in one of the countries in Europe, the narrative is a shortage of truck drivers, not on the molecules. So it depends on from country to country, but we can say it's a major supply constraint in the face of rising demand.
Up next, stocks slip after a jump in Treasury yields on the prospect for a more hawkish Federal Reserve. Meanwhile, 2 regional Fed presidents are retiring following embarrassing revelations of stock trading last year. The full details, that's next. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Welcome back to the best of Daybreak Middle East. We had more hawkish messaging this week from the Fed. Lael Brainard and John Williams both signalled that the time for tapering could be soon. Their comments sent yields spiking higher, with both the 2 and the 5 years hitting levels that we haven't seen since 2020. Meanwhile, Fed officials Robert Kaplan and Eric Rosengren, well, they quit within hours of each other in the wake of embarrassing disclosures about their trading activities. We got more with Monica Defend, the head of global asset allocation over at Amundi.
Maybe this will be reflected into the dots that in any case will remain quite volatile. I think that broadly speaking, the tapering discussion is on and is a shared common sense across the Fed member. So in any case, they are start looking at inflation expectations that in the short term in particular appear to lift higher. And this is what all the Fed officials will be looking at.
Monica, good to have you with us this morning. Certainly, the short end of the yield curve and even the 10s have got all lit up. I mean, you've got Esther George, Loretta Mester, Williams, all overnight, along with Brainard now talking about, of course, substantial further progress. When I look at two-year paper up for 5 days in a row, breaking the 2020 highs, do you get a sense that the bond vigilantes are getting what they want, and we could see substantially higher yields at the shorter end and the 10 part of the curve?
We tend to see some cap on the yield, meaning that in any case, it is true that we've been worrying about too much inflation, but there is another worry, which is not enough growth. And this is eventually will cap, in particular, the long end. So I'm not really sure that eventually we will see skyrocketing yields, and this will maintain yields compressed, in particular in the long end of the curve.
Monica, I want to take you to Germany, where in the last few hours we've had, of course, the results of the German election. Olaf Scholz looking to be in a good position. He's the current finance minister. In your research note, you say this is one of the top things to watch. Just tie the two things together for me. A, the split outcome of the election, and your perhaps opportunistic view on European stocks.
Yeah, sure. Well, actually, the result of the German election shows how fragmented the vote was, which is maybe the first time in history, as far as Germany, at least, is concerned. So the government will be formed on a coalition. And what we are looking at is the role of the Greens, because Greens are going to be vocal. And eventually, this is for us an investment opportunity with this green transition that the European state members would like to take. So on the equity sector in particular in Germany, on the automotive with the e-mobility subject, these are all things that we are going to be on and positioning for investment opportunities.
Are you worried about the spike in the price of oil, Monica? Natural gas, we're in a process of crisis. Brent is breaking above $80. People are talking about $100 oil. Could this unseat any of the European rally?
Well, this is not definitely making me happy. It is an issue on the real economy, because the higher prices eventually are going to pass through higher bill or higher taxes. Somewhere we've been a state intervention. Look at what happened in Spain with the utility sector. But definitely this is something that is eventually going to create some political debate and possibly some social tensions if oil prices are going to move much higher than current levels. Having said that, there is this green transition deal that Europe has been subscribing. So maybe we're going to move faster and take this an opportunity. But the fact that we are going on a green deal on the other side implies that capex on the oil side has been reducing, and if we get short on oil, then this might be a risk.
Let's get back to the global energy crunch. We caught up with Oliver Kettlewell on the implications for global markets. He is the head of fixed income and global portfolios at Maastricht Capital.
If you take the Fed's reaction function, the Fed cares about core inflation. It doesn't really care about headline oil inflation. So we don't think they're going to react to it, and we're not going to make any dramatic decisions either. And even if we're wrong on oil, and if oil does, as you say, linger above 80 or even goes to $90 like Goldman Sachs are forecasting by year end, that's actually going to choke off growth, and that's actually going to pull down the long end of the yield curve. So we're still quite happy and comfortable sitting at the long end of the yield curve in 30-year bonds.
In terms of what the Markets Live team has been looking at, they've written out the question of the day, and they do this, of course, 5 days a week. And today's question is whether stagflation or taper is going to hurt assets more.
So, I mean, we would actually say neither. I mean, certainly not tapering. I think the tapering event is known, right? We've all been talking about it on your show quite a lot. It's a known event. It's happening. We even know the timeline now. I think if investors are worried about tapering and a potential taper tantrum, they've missed the bus, because we had the taper tantrum in Q1. Yields rose by 90 basis points in Q1. That's a massive move. We don't expect them to move by a similar amount this time round. And as far as stagflation goes, yeah, I think it's more likely that growth will come down, but stay above trend rather than inflation. I think inflation and growth are still going to be fine for investors to stay invested in both bonds and stocks.
Let's take a quick listen to what the Fed chair had to say in the last few hours, a bit of guidance on the tapering process. Here we go.
We had set a test for beginning to taper those purchases of substantial further progress towards our statutory goals. We haven't met that yet, but as I mentioned, I think we've all but met it on the path that we're looking at. We would continue to add accommodation, not subtract it, until well into the middle of next year. And we think that's appropriate given the strength of the economy. The test for raising interest rates is substantially higher.
So he talks about all but met the test for tapering. Why do you think the market, especially in the last few hours, has gotten quite anxious? I mean, the selling that we saw overnight, the S&P 500 down 2%, is a bit strange, because it's not like any of this is a surprise.
Yeah. Well, I mean, in terms of stocks, they've had a really good year, right? You're seeing double-digit returns for most developed markets, including the US. So I think it's natural that you're going to have these pullbacks occasionally. We talked about oil being one of the reasons. Oil's at a 3-year high. I think another reason is concerns over tapering. And third and final reason would be the debt ceiling coming up. I think investors are getting a bit jittery about the fact that whether the US will default on its debt. The US has a habit of leaving it to the 11th hour to resolve this issue, but at the end of the day, we think they will do. And so, yeah, the markets could sell off a bit more in the coming days, but we would still say that's an opportunity to buy, not to sell or run for the hills.
I mean, just to flesh out that point, what we saw on the NASDAQ, the worst day since March of this year, you're saying this is an opportunity to buy. Is it just US stocks? Is it tech thematic plays through ETFs? What are you telling clients here?
Yeah, I think because if you take the growth value to it, right, and tech is more growth. I mean, if we were getting new money into the door today for our funds, we would be allocating to growth rather than value, because growth has sold off the most, and growth has sold off because yields have risen. And as I said before, we think yields are going to retrace, and if yields retrace, that's going to be good news for growth stocks such as tech. So we'd be fine allocating more money to tech, even if there is a continued sell-off in the coming days.
Let's get to the Evergrande story. You actually had exposure to that particular name. You sold it 2 months ago. You think the market has priced in sort of the wider ripple effect from the Evergrande fallout? Or do you think there's still quite a bit of a learning process to come?
Yeah, I think there is. I think there's still going to be certainly winners and losers from this Evergrande saga. You're right. Thankfully, we sold the position in May when the bond was trading in the 80s. It's trading at distress levels now. So the way we're looking at it, property in China, it's a really important sector. I mean, property is 25% of the economy. So, and it has some of the highest yielding names and some of the most profitable potential stocks. So we still want to be invested in China. We still want to be invested in the property sector. But the way we're playing it is we have our biggest positions in investment grade China property names. So Cmpro is one, Country Garden is another. These are two names which meet all of the Chinese regulators' 3 red lines policies. So they've got lower leverage and strong liquidity. So these are the sort of names that are going to see themselves through the crisis. The ones where there could be contagion, which was your point, I think you could see it in high yields, single B names, which are still highly leveraged, similar to Evergrande. So we're shying away from those highly levered names, sticking with investment grade for now.
What about China tech in comparison to what the fixed income space is offering?
Yeah. I mean, China tech as well. If you compare China tech with US tech, and I said that, we'd still be comfortable investing in US tech right now. But if you were to ask me if I had to choose between China tech versus US tech right now, we would choose China tech. If you take Alibaba versus Amazon, for example, Alibaba has lost nearly half its value over the past 12 months. Amazon has continued to rise. Alibaba has a PE ratio in the teens. Amazon has got it, I think, in the high 60s. Alibaba has better margins than Amazon as well. So I think there's a lot of fundamental reasons why it's probably a better value play to go into China tech right now. Sure, they've got the headwind of the China crackdown on the sector, but it's an important sector, and the government's not going to let it go to the wall. So we're pretty comfortable with China tech too.
And in terms of building in some exposure to Europe, is that still on track to outperform based on our conversation last time? Would you say that a lot of the catch-ups already occurred?
Yeah, I think you're right. I mean, Europe's done better than we expected. We have a slightly overweight allocation, but the biggest allocation is still in the US. I think Europe can still chug higher. I think the ECB is going to be very accommodated, even more so than the Fed. They're not going to be able to raise rates next year, 2023, and perhaps let alone ever, the way they have problems generating growth and inflation. So I think Europe's still a great place to be. And if global growth holds up, Europe is actually a pretty good place to be compared to the US as well, because they've got so many great global growth companies in Europe.
Up next, COVID-19 related shocks and log jams. They're raising the shipping rates as well as the price of goods and commodities. But Akbar Khan from Arayan Investments thinks the disruptions will prove a boon to the Gulf. We hear from him. That's next. This is Bloomberg.
Companies. Join the fastest growing venture capital investment.
Might it impact China's growth because it is already slowing? Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, settled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Who are U.S. Open tennis champion Emma Raducanu's three dream dinner guests?
Daniel Ricciardo, Michael Jordan, and Tom Keane from Bloomberg.
She understands you?
Funny and very understandable.
I am reading in on tennis like nobody.
Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
Welcome back to the best of Daybreak Middle East. COVID-related shocks, log jams, they're all hitting shipping rates, as well as the prices of goods and commodities. Well, it's a headache that's unlikely to dissipate anytime soon, but our guest this week said he's betting the disruption will prove a boon to the Gulf. He's Akbar Khan, Senior Director of Asset Management at Arayan Investment.
The expectation after COVID hit was that there would be severe problems with demand, pretty extreme and extraordinary stimulus from governments has helped demand come back. But really the lasting problem at the moment has been distortions to supply chains. They've been creaking. And, at the same time, we've had the transition towards the global economy really pick up speed because of the focus on carbon emission reductions. This has led to a number of issues. You've been talking about petrol shortages. This has led to changes in usage of fossil fuels, a reduction in usage of fossil fuels. All of these things have led to a surge of a wide range of commodity prices, and a lot of the best global debt and equity plays for those are actually in the Gulf. So we've kind of come full circle, and bingo, here we are in the Gulf, able to capitalize.
I know that you certainly got my eyes going. Vinyl acetate, I thought that was for records, but you've expanded my horizons. Can we just qualify for our viewers? Is there a great deal of depth and breadth in ammonia, aluminium, vinyl acetate and LNG? What is my risk trading directly into those commodities? Is there enough depth there, first of all? Just qualify my risk.
It's a good question. We would actually we see far greater leverage in buying the companies that manufacture them rather than buying the underlying.
Okay.
Because of operational and financial leverage in those companies, you will get probably very strong returns, and you will avoid some of the liquidity that you may encounter otherwise. The likes of Qatar Aluminium Company, Sabic Agri, Safco, as people know it, Sipchem, Ma'aden, Industries Qatar. We've been flagging many of these for a while. We expect them to have record profits and in some cases record dividends next year. But this is how we would play a lot of these trends.
So just on that, I mean, we're showing our viewers that board. Of course, we're in the classic disadvantage. I've got the board in front of me. We've got Qatar Industries, Sabic, etc. The one thing that went through my mind, and Yusuf Al-Bayan owes us an interview. His FLAC will not respond. Do you think that these companies grab market share in a crisis like this?
Well, by virtue of of having some of the lowest cost producers in the world in the Gulf, that's one of the reasons why when you have crises where you have surge in commodity prices, people think of the Gulf and they think of oil and they think perhaps of gas, but really we produce a lot of the derivatives of these, or we produce commodities in the region which utilize very cheap energy, and as a result we have some of the lowest cost producers. So that's why some of these companies in the region are some of the best ways to play this globally.
Akbar, that brings me to, I've got one other CEO who's sending me WhatsApp talking about his own call on oil this morning. The last time he was with me, it was rather prescient. Oil's over $75 this morning. We're breaking higher. People at Goldman Sachs are talking about a tight market, and they've upped their Brent price by $10 to $90. They also lifted their 2023 outlook to $85. Does this squeeze endure? Do you agree there's another $10 left in the upside? And what's the consequence of that $80, $90 oil if it endures?
So I think 2 or 3 months ago, Manus, you and I were having a chat about this very thing. I think oil at that time was in the mid-70s, and it came down again, and it's come back up. And really, I think from our perspective, over the medium term, the transition to the green economy is going to be very beneficial for oil and gas exporters. It sounds counterintuitive, but because there is so much pressure to reduce the medium-term supply growth of fossil fuels, the counterbalance, if you like, which is the increase in demand from renewable energy, is not coming up anywhere quickly enough, and is not as regular. So as a result, we've had coal mines come back being activated. We've had an increased demand for increased oil production, et cetera, et cetera. So we think that as this transition to the green economy continues over the next 5 or 7 years, it'll underpin oil prices. So whether it's 70, 80, 90, 100, there is room for surges higher in some of these prices. Sustainable numbers to avoid demand destruction probably don't want numbers around $100 oil, but it's possible for us to see this from time to time.
Let's circle back to one of the companies which is in the process of delisting here, which is DP World. Now, it's interesting that you talk about the boom in e-commerce, the shipping, the freight mania, and the freight rates. We obviously can't play DP World via the equity story anymore, but you do like, and we love a sukuk on this show, you do like the bond exposure. I'm showing our viewers a 6-year perpetual sukuk, and this is where I think that you have a pretty strong call. Where can DP World 6% perp get to? Where can price rally to and yield fall to? And do you scale into it?
So, thanks for highlighting this. The DP World is one of the strongest credits that we actually have in Dubai. It's currently rated BBB-. It has many sukuk on the curve. The PERP, which is a $1.5 billion issue, is our preferred play. It has a first call in October 2025. And if it doesn't get called, the 6% coupon gets stepped up by 500 basis points. So it'll become 11%. So the expectation of the call is very, very strong. The key thing here is that this, with a high coupon, a yield which is north of 3% at the moment, there's a considerable pickup relative to the rest of the curve. But the key point here is that given the number of acquisitions over the last 18 months, leverage is about 6 times net debt to EBITDA. The company has an internal target of bringing this down to closer to 4 times. And if they do that over the next couple of years, you could see a definitely 1 and probably a 2-notch rating upgrade. As a result, you could see the spreads come down sharply. The price would obviously react accordingly. But there is still significant further upside in this. Even if it doesn't go anywhere, you're getting a 6% coupon just to play the waiting game.
Up next, why governments that once relied on vaccines from Chinese producers are increasingly turning to the options from elsewhere. This is Bloomberg.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the best of Daybreak Middle East. Governments that once relied on vaccines from Chinese producers are increasingly turning to options from elsewhere. Concerns are mounting about their efficacy against Delta and the Western stranglehold on mRNA shots. Well, that seems to be growing looser. We got more on the story with our senior medical reporter, Michelle Cortez.
It's important to remember where we were in the beginning of the outbreak. We did have access to the shots from China, while in the U.S. and Europe, the mRNA vaccines, which did appear more potent, were really kind of being hoarded by those countries. There just wasn't access. So the question is, for those countries that received the early Chinese shots, were they better off getting them than getting nothing? And the answer is absolutely they benefited from having those shots. We know that the number of infections do go down. Hospitalizations and deaths decline significantly with the Chinese shots. So better than nothing, absolutely.
I mean, probably in excess of about 70% of the world accepts the Sinopharm as a legitimate and effective vaccine. I'm wondering, though, as maybe there begins to be a transition, what happens to, the supply of shots that have already been produced?
Well, that's a good question. At this point, we still have hundreds of millions of people around the world who need to get vaccinated. And the other piece to remember is that we're looking at multiple shots at this point. No one is thinking that the 1 or 2 doses that were originally rolled out is going to be enough to get coronavirus under control. We've seen a number of studies that show that mixing up the different vaccination approaches actually gets you a better benefit than just sticking with the same thing over and over. So some of those Chinese shots, getting those first, if you follow that up with an mRNA chaser, you might get a better benefit than if you had just stuck with one approach from the beginning. So there is that. And also, you've already primed your immune system from getting the earlier doses. A question of where we're going to be going in the future, where the vaccination manufacturing is going to go, it does look like the mRNA shots from Pfizer, BioNTech, and Moderna are more potent, and hopefully other countries are going to have more success in rolling out their versions of those shots as well. That's where we need to focus our manufacturing, but absolutely having the early Chinese vaccines on board is not a bad thing for people who went that direction.
Look, many people use the phrases vaccine nationalism, protectionism. There was a certain amount of diplomacy. The Chinese were accused of wielding power on a pan-African basis and around the world. Has it backfired in any way, this vaccine diplomacy?
There is a lot of sensitivity around this, of course, because many of these countries work closely with China and they don't want to poison that well in any way. On the other hand, they are seeing the reduced efficacy from these vaccines, which just science is telling us. So how do you go forward? You don't want to cancel your contracts. You don't want to offend the Chinese manufacturers in any way, but you also want to get the most potent protection for your population. And that's what many of these countries, like Singapore, Thailand, Hong Kong, are dealing with at this point. So it is a very sensitive area. At this point, we haven't seen anyone do anything big in terms of blowing up that relationship, but it is definitely something that countries have to deal with very sensitively.
Remember, you can get us here on Daybreak Middle East every Sunday to Thursday morning, right here on Bloomberg Television, 8 a.m. Dubai time. Join us then. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is my kitchen table and also my filing system. Over much of the past 3 decades, I've been an investor. The highest calling of mankind, I've often thought, was private equity. And then I started interviewing.
While I watch your interviews, I know how to do some interviewing.
I've learned in doing my interviews how leaders make it to the top.
I asked him how much he wanted. He said $250. I said, fine. I didn't negotiate with him, and I did no due diligence.
I have something I'd like to sell, and how they stay there. You don't feel inadequate now because being only the second wealthiest man in the world. Is that right? When I was a young staffer on Capitol Hill, I met a man named Stephen Breyer, who was a law professor at Harvard. I thought, very smart, he'll probably be an academic the rest of his life. But actually, he became a justice of the Supreme Court and has been in that role for 27 years. I recently had a conversation with him about his future and about the future of the Supreme Court. I have to start with the question that's on everybody's mind, obviously. Why is this book that you've just written so small? It's a very small book, and I'm used to bigger books. So why is this book so small? I mean, why didn't you get a bigger book?
This is the Constitution, and it's smaller.
Okay, all right. A lot of justices of the Supreme Court carry around the Constitution all the time. Is that because you're going to forget what's in it, or are you... You just like to remind people, or you just read it over and over again?
You never know when somebody's going to ask you a question. You see, somebody says, what does Article 3, Section 19 say?
Okay.
And they expect you to know.
Okay, so you have
So you have it here. Yeah, there it is.
There it is. So your book, this book is a interesting book in the sense that it came from a series of lectures you gave, named after somebody who was an ideological, let's say, opponent of some of your views, and that was Justice Scalia. So were you a friend of his, even though you had ideological differences?
Yes, I think so. We would debate those differences, and we'd go. I thought we had a terrific debate in Lubbock, Texas. There were several thousand students who'd come. They'd never seen a Supreme Court justice, and we talk about our differences. You know, I say, hey, if I had your theory, my goodness, do you think George Washington knew about the internet for free speech? Do you think and Scalia would say, I knew that. Well, good point. Then he would say, I'm not saying my theory's perfect. He would say, you know, the two hunters, they're hunting bears, and one's putting on his tennis shoes. Where are you going? And he says, bear's coming. He says, you can't outrun a bear. He says, yeah, but I can outrun you. Right. See, that was his view of my way of deciding cases. And I never, and I still, 28 years now, I've never heard a voice raised in anger in that conference room. I've never heard one justice say anything mean or even snide
at the table or anything like that?
What good would that do? I try to explain that to the students. You know, you get all excited, and all that happens is people disagree with you, think, well, you know, he's all excited, he must be wrong. And that's so true. So we get on well personally, and we're friends personally, and we disagree on some things. Not as many as you think, but some.
It's not always been the case. There was a Supreme Court justice who refused to talk to or be in the presence of Justice Brandeis because he was Jewish.
McReynolds.
Right. So it hasn't always been that friendly. No. But you're saying right now, since you've been on the court 28 years, people don't yell and scream at each other.
No. And they don't insult each other, and they're not rude to each other. And it's a professional job, and you go in and do your best professionally. And if you want people to listen to you, the best you can do is to think through this problem. Listen to where the other person is coming from and see what you can contribute to that thought.
But sometimes the dissents are a little bit tough on the person who wrote the majority opinion. Nobody takes that personally.
I get that question a lot, and I used to get it more when Nino Scalia was on the court. And the two of us would be there, and somebody would ask that question, and I'd try to answer it because I didn't want him to. And I'd say, look, I know you're not aiming that question at me. You're aiming it at Nino. Okay, I get it. But what you don't understand is that some people suffer from a disease. It's called good writer's disease. Okay. And if a good writer finds a felicitous phrase, he won't give it up. Let him destroy himself. Let the world come to an end. It's like a good comedian. You can't give up that joke. Now, that's Nino. He is a very good writer. He has a felicitous phrase, and we all know that, and we don't take it personally.
Do you have a lot of unanimous decisions these days, or they don't get that much attention? And do you really have a lot of 5-4 decisions, and they get all the attention, it seems? But is that where the court really has its arguments with each other, the 5-4 decisions? And
no, not necessarily. What you read about are the ones that the press thinks the public will be interested in, which usually has a political or a social content. And they'll say, that's the most important. I don't know. One of the most important decisions I wrote this last year was called Google versus Oracle.
Right.
And it took a year for me to write that. It was about copyright and something called interface programs. And I was told that was very, very important. Well, for me, it was like learning Latvian. I mean, I don't know how I did that. But you see, I'm not saying I see what they're saying. I see what they're saying. And it's true that a lot of the sort of exciting cases are more close.
But do the justices, let's suppose you have a decision, it's 5-4, and one justice kind of go to another justice's chambers and say, you know, your argument isn't so good, and maybe you should do something different, or is everything just done by memos and writing? You don't have people going down the hall and saying, let's have lunch together, and maybe I can persuade you my position is better than yours. Does that ever happen?
Most of it is memo, but quite a lot can be visits to chambers. But if I'm going into your chambers, I'm not going to say, no, your argument isn't so good. This would not be a helpful way to start the conversation. And if you go into somebody else's chambers, you better be prepared to listen to them, as well as hoping that they will listen to you. And then you try to see, and that's what I learned in the Senate, that's what you try to see is, where is there some common ground? And is there common ground enough that you can work with it?
Basic economics is, for all countries, in all time, is that if your debt is in your own currency, you can deal with it.
You can work it out.
You could work it out. We've seen it happen over and over again.
What have we learned from this Evergrande crisis so far?
From my investment perspective, I think diversification is very important. So far this year, we see many events, right? Maybe in the fintech sector, and education, casino, and property. So I think diversification help you lower your risk on your overall portfolio.
Medium term, though, are you seeing more risk and reward in the high yield space in Asia? I mean, how are you viewing this right now? Are there actually buying opportunities given just the selling we've seen?
This time is a bit different in the property cycle, because in the last, when you see there's a tightening measure, there's always demand there, right? Just the government trying to suppress the demand. But this time we're seeing a confidence issue, is like a buyer strike. Because of the sentiment, the Evergrande is hurting the sentiment, and people don't want to buy. And other developer, because they want to get cash.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Let's go back to your earlier life. I worked on Capitol Hill, and you worked briefly on Capitol Hill. You were a Harvard Law professor. I'm just curious, when you go to Harvard Law School and you're at the top of your class. When you start Harvard Law School, there's always kind of an intimidation factor. You have 600 people. You have to figure out, are you going to be good or not? When did you realize you were really good at law school kind of things, taking exams? Did you know right away you were going to be a great law school student and therefore become a potential law school professor? Or were you nervous the first year or so?
I think I was pretty nervous. I remember talking to a friend of mine I'd been an undergraduate with, and he was there too, Paul Dodick, actually. And we both said, well, this is the end of our great careers. That was after our first year. And we both did pretty well in law school.
So you were on the Harvard Law Review, and when you're on the Harvard Law Review, sometimes you get to clerk on the Supreme Court for another justice, and you clerked for?
Arthur Goldberg.
And what was that like?
It was terrific. He was great. He was an enthusiast. He had loads of energy. Jack Kennedy said that he was the smartest man he ever met.
So you clerked for him, and then you went to teach at Harvard Law School.
That's right.
And when you went to Harvard Law School, did you say, this is going to be my life? I'm going to be a professor, nothing terrible about that. You can teach great law school students and so forth. Or did you say, maybe someday I'll be on the Supreme Court, maybe I'll be a judge? Was that in the back of your mind?
I didn't think maybe someday. Anybody who thinks maybe someday I'll be on the Supreme Court, I don't want to say there's something wrong with him, but there is something wrong.
After teaching at Harvard Law School, you got a very good reputation. Senator Kennedy invited you to come down and work on his staff, I think to work on regulatory reform.
Yes.
And that's where I first encountered you, and I was working on Capitol Hill and so forth. You've got a very good reputation. And then something happened that was a surprise to people. President Carter nominated you to be a judge on the First Circuit, and that's not a surprise given your reputation and so forth, but it required a Republican to sign off on it, Strom Thurmond, one of the most conservative Republicans. Why did you think Strom Thurmond said he would let a presumably somewhat liberal Harvard Law professor get on the First Circuit?
Those were days. It was a different day. You remember that. People did try to work together. Right. And every single morning, Ken Feinberg, who was I was chief counsel and he was a general counsel or something of the Judiciary Committee, and we would have breakfast with Emory Sneeden, who was a former JAG general, and it was Strom Thurmond's chief person on Judiciary, and we would plan the day. We planned out the day. We wanted no secrets. We wanted to try to accomplish something. And we'd figure out how do we color it red for this party and how do we color it blue for the other party. But the important thing is, if it's desirable, let's try to get it through. That happened a lot. I can't say there was no conniving, but Ken and I and Emory used to call what we did open conniving, openly arrived at.
Okay. So you went on the First Circuit, and you had a very good reputation there. And then you were being considered to be on the Supreme Court. And so you came down for an interview with President Clinton, but you had a bike accident, and you had a lot of injured bones, if I recall. So did you think that was bad karma, that you had this accident before you had the interview, and did that affect your ability to do the interview well, or it didn't make a difference?
I have no idea. That's the truth of the matter. And later I thought about it, and of course the newspaper people wanted to say, weren't you terribly disappointed, da, 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 da. And I said, I'll tell you why. I said, well, it's not such a terrible thing in your life to be seriously considered to be on the Supreme Court, even if you're not appointed. And that's about the best you can do. And I was thinking partly I said that because it's true. Okay. And partly I said it because I did have children. Hey, my friend, you don't always win everything you want. And my goodness, what you want those children to learn. And you want them to learn, fine. Sometimes you'll get everything your heart desires, not very often. And sometimes you won't. And you better be a good sport about when you don't, as well as when you do.
Well, Mick Jagger has a song about that. You can't always get what you want, and so
right.
You didn't get it.
That's after my generation.
Okay. So Justice Ginsburg was appointed first, but then you were appointed next by President Clinton.
Yes.
So when you got on the court, how had it changed from when you were a clerk? Was it much different, and were you surprised by the changes?
Yes. I thought it was different in this respect when I clerked. I felt it was a court with a mission. What mission? In 1954, the court had decided that Plessy v. Ferguson, rightly, was down the drain. And legal segregation is contrary to this document, equal protection of the law. They said it in 1954, and we both know what happened in 1955. Nothing. Right. Next to nothing. 1956, yeah, double nothing. 1957, a rather brave judge in Little Rock said those Little Rock 9, those 9 brave black students are going into that white school, Central High School. But the governor, Governor Faubus, said, maybe those students have a court order, but I have the state militia, and they're not. And Eisenhower, I'd like to see that at the monument that they're building for him. He called in 1,000 troops from Fort Bragg, the 101st Airborne, and they took those 9 black children and walked into that white school. No, I'd like to say that's the end of the story, but it wasn't. What happened was after a few months, the troops had to withdraw. And when that happened, the school board said, we're not going to integrate anymore. And when that happened, a very famous case went to the Supreme Court, Cooper versus Aaron. And when that happened, all 9 justices signed the opinion saying, integrate now. Do it. Right now in Little Rock, hey, but there are 9 people. Maybe there could have been 900. Maybe 9,000. Faubus closed the school. That's what happened, for those of us who remember and those of us who don't. But they couldn't keep it closed, because that was the era of Martin Luther King, the Freedom Riders, and suddenly the North woke up. And others woke up and said this is an intolerable situation, and eventually, through a lot of work and a lot of moral effort and a lot of physical effort and a lot of organizing effort and so forth, eventually, legal segregation was brought to a conclusion. And the reason that I find that story important, and I told that story to a woman from Ghana who is the Chief Justice, who is trying to improve the constitutional system there, and asked me, why do people do what you say? And my response was, ma'am, 301 million people in this country, and 300 million are not lawyers. That comes as a surprise. And those are the people you have to convince. Convince what? Convince that they should try to follow the courts or the rule of law when they don't like it, when they think it's wrong. And that's why I wrote this book. In a sentence, that is why. I want people to see in some detail. It's not moralizing, it's my experience. And I want them to see what the court can do. But when you say the court can do, it doesn't mean 9 people. It means the country, as it's come to develop a long time, 200 years, and then maybe we have a country that can use this weapon called the rule of law in order to prevent some pretty terrible things.
What would you like most people to know about the Supreme Court?
A judge is there for all Americans.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The growth story in cannabis remains very strong even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Let's talk about what's called the shadow docket. For the people who are not lawyers, what is the shadow docket and why is it becoming such a big thing?
What it is that in between hearing the cases on which we have decided to hear, someone will make an emergency motion. Now that's what it is, an emergency motion. The country is divided. I'm in charge of the First Circuit, for example, but everybody's in charge of some circuit. So if there is a litigant in the First Circuit who believes that he needs immediate attention to issue an injunction or to stop an injunction, well, then he'll file it with me, and I'll look at it, and most of them there isn't much to. And so it's easy to deny it. But some there is something to. And then I usually will refer it to the whole conference. And if I should have and didn't, he can go to any other judge and it will be referred to the whole conference. Most of these that are the subject of the whole conference are death cases, and at the very last minute. Because of COVID, I think, there have been some recent cases which did not just involve the death penalty or something that wasn't too difficult. And there I thought I was in the dissent in those cases.
Well, the most recent abortion case.
I was in dissent. I thought it was wrong, and I thought we should have heard the whole thing. It was a procedural matter. They didn't decide the substance of the statute.
But there will be a case presumably working its way up to the court, but it might take a year or so for a...
Well, there is a case in November where that's the subject matter.
You've been on the court now 28 years. What are you most proud of having done, and what's the pleasure of being on the Supreme Court?
It's a great privilege to be on the court. I mean, there's no doubt. And from a personal point of view, I'd say it requires you in middle age, when you get there, to give your best to this every minute. And you say, is that a big virtue? Yeah. And the older you get, the more you see it as an enormous virtue.
Einstein famously said, if you try something over and over again and expect a different result, that's the definition of insanity. So if somebody asks you a same question over and over again, expecting a different answer, I guess that's the definition of an insane interviewer. But let me ask the question you've already been asked many, many, many times. Mm-hmm. I know you're not going to give a different answer, but I have to ask you the question, what is your thinking about all of the issues relating to your retirement?
Yes.
Okay.
Einstein was right.
Einstein was right. Okay. So you have said that you don't want to die on the court, and presumably nobody would want you to die on the court. So what do you...
It's Einstein is coming back.
Right. So what is it that you would like to do when you are alive after you're off the court? In other words, would you like to go teach again? Would you like to write? Would you like to just take life easy? What would you like to do?
It's hard to take life easy, but I don't know. We'll see.
Okay, so you haven't thought about what you might want to do? Or
no. Different thoughts go through my mind.
President Biden has put together a commission that's going to look at the court, and you have already articulated your view that you don't think expanding the size of the court is a wonderful idea. I think you've said that.
What I've said is that they better be pretty careful about it, because two can play at that game. And of course, what's worrying me, and I say this, I try to explain to people in the book the extent to which politics is relevant or not relevant, or present or not present, and in what form in the work of our court. And what worries me is that people will think we're junior league politicians. And if they think that, the second thought should be, why don't I have a senior league politician? And once you begin to think along those lines, two can play at that game, as I said. You could have Republicans appointing and then Democrats appointing and vice versa. But I see the overall tendency of that is, given the history, given the way we work, given the country, etc., as weakening the confidence of the average person in the decisions of the court. And you can say, what's wrong with that? And I say, well, that's sort of a step towards or away from a rule of law.
What would you like most people to know about the Supreme Court? If you could say to the average citizen, here's what you should know in a paragraph about the Supreme Court. I assume, it would be something along the lines that it's not as political as some people think, but what would it be you would say?
A judge, once he puts on that black robe, I'm not going to say it's a midnight transformation, but look, a judge, and I have to think this about myself there too, I have to. A judge is there for all Americans. He's not there just for Democrats. He's not there just for Republicans. He's not there just for the president of the party that appointed him. And even if half the country thinks he's a real idiot and they can't stand what he writes, in his own mind and the way he approaches the job, he has to remember he's there for everybody, all 331 million.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
you look
drop
great.
The bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
What did you think at the low point of the Greek economic debacle? What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms, and I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
This week, Germany's climate election. The Green Party hit their best result ever, with the transition to net zero firmly on the agenda.
One thing is clear, climate is going to be one of the most important topics, no matter what kind of coalition constellation we will get.
Decarbonizing the energy industry in Europe's largest economy. We'll look at the options available for the new government as coalition talks rumble on.
The incoming commission has a lot on its plate. The incoming coalition will have to sort out many of its differences to really make that step change happen and cut those emissions to levels that are required.
Plus, the car industry is a pillar of Germany's economy. But can the country's automakers keep up with the EV transition?
It's really, really important that this is managed carefully and thoughtfully, this transition from the combustion engine to batteries, because so many jobs are at stake.
I'm Kaylee Lyons at Bloomberg World Headquarters, and this is Bloomberg Green. Germany has decided. Olaf Scholz of the center-left Social Democrats defeated Chancellor Angela Merkel's Conservatives in Sunday's extremely tight election. It sets in motion what could be months of complex coalition talks to decide who will lead Europe's biggest economy. A key theme in this run-up to the election was climate. Devastating floods during the summer campaigning period highlighted the risk that German voters face. And Germany's Green Party ended up with their best ever electoral result. We spoke to Sven Giegold from the German Green Party on election night.
I hear now other parties starting to stalk us for coalition. I'm looking forward for the office because it's very clear that there has been a huge defeat for the Christian Democrats. On the other hand, we have won a lot, so therefore politics have to become greener, more social, more European. That's what our voters want to see.
Well, joining us now from Berlin for more is our reporter Maria Tadeo, who's been covering every step of the election. So, Maria, just talk us through the role that climate played in this vote.
Right. So we know that climate was a key theme in this election. You mentioned the floods that were devastating for regions in Germany. We also had a return of the Fridays for Future. That was a movement, of course, that was initiated by Greta Thunberg. If this is something that for many of the young Germans really, really matters, especially when you look at the changing demographics in this country. Climate is something they deeply care about. You also mentioned the Greens having this huge election night on Sunday. Annalena Baerbock, the Green candidate, at Wood Point, did lose some of the momentum in the campaign, but nonetheless, this is their best result in their history, being in third position. But this is not just about the campaign, is looking forward to the next coalition government. And the Greens will have their biggest say as their kingmakers in recent German politics. We know that whatever government comes out of this election, and it does look like it will be an SPD-led government in a traffic lights coalition, climate will feature very highly. The climate transition, going climate neutral, cutting emissions, reshaping the German industry, particularly the autos, in a way that they're more compliant with some of the regulation that's coming out of Germany, but also Brussels will be key on this election, as it was, but also in the future government negotiations and, of course, the future government of Germany, which climate will be a defining issue throughout the next term.
All right, Bloomberg's Maria Tadeo in Berlin, thank you so much. And as Maria says, we have to look forward toward the future, and we'll do that with Guntram Wolff. He is director of the think tank Bruegel. He also previously held positions at the IMF, the European Commission, and the Bundesbank. So, Guntram, great to speak with you. Can we call this election a watershed moment for Germany?
Well, thanks a lot for having me. Look, this has been a very important election, obviously, because it marks the end of Angela Merkel's chancellorship. She has been in power for 16 years, and now the country is trying to figure out where to go, what to do next, and how to shape its policies going forward. And one thing is clear. Climate is going to be one of the most important topics, no matter what kind of coalition constellation we will get. It is clear that the Greens, in all likelihood, will be in the government, and they will demand concrete action on climate. And even before, there had been broad agreement across the political spectrum, and there had been even a law to decarbonize the German economy by 2045, so earlier than the European Union wants to decarbonize its economy. So the intention is clear. The debate is now really about how to get there, what is the best approach, and how to make that politically actually acceptable and feasible.
Is the 2041 goal of carbon neutral Germany that the Greens have politically realistic at all?
Well, I mean, obviously it's not just the Liberals and the Greens that are voting and that are governing. It's going to be also the Social Democrats or the Christian Democrats, and both of those parties, so the old big parties, They want to preserve coal quite long as possible. I mean, the coal transition, exiting coal, is supposed to take a lot of time. I mean, the current agreement, I think, stops the last coal-fired power plant in only 2038, which would be very late. So politically, it's very difficult because there are important constituencies in the coal mining regions, in the workers in the coal-fired power plants, the car industry. I mean, there's many sectors where, of course, there's a lot of resistance and, striking the balance between, I think, the objective need of decarbonizing rapidly and, ensuring that socially and politically this is viable is going to be extremely difficult, and it's going to be at the core of these discussions.
Yeah, the constituency factor is so important here. I mean, when you think about who voted for the Greens, it was primarily young urban voters. But do you see them expanding their voter base in the elections of the future? Are they just going to continue to gain more influence?
They are mostly popular among the young, but I think the topic climate change is certainly a mainstream topic, and more people realize that we need to invest massively in mitigation and in adaptation to climate change. So this topic will gain in importance, and the Greens will try to leverage votes and get more votes out of it. But other parties are also increasingly entering into that space, including parts of the Christian Democrats. So this will be a very politically contested field. And in a sense, the result of last Sunday was a disappointment for the Greens. I mean, the Greens, I think, topic-wise, could have gained probably 20% or something like that, but they didn't realize their full potential.
Guntram, obviously, Germany is Europe's largest economy, so it's not just about what happens domestically within Germany. They have a massive role to play in Europe as well. How do you think the election result kind of shifts the priorities that Europe will have going forward?
Well, the European Union also has extremely ambitious climate goals, and it has the European institutions have put a package on the table that has to be now put into law. It's called Fit for 55, but it basically means we want 55% reduction in emissions by 2030 relative to 1990. And so this is an ambitious scheme, an ambitious goal. But it needs to be agreed on. And so here the German vote and the German positioning will be extremely important. And that concerns many regulatory aspects. So it will be very important who runs the German Environment Ministry and Energy Ministry. But it also concerns, again, the fiscal matters and the European fiscal policy making. And so that's where the Finance Ministry, the German Finance Ministry, will be key. Who will run the German Finance Ministry? Will it be Christian Lindner from the FDP, or will it be Robert Habeck from the Greens? I mean, that will be quite decisive also on the fiscal policy debate at the European level.
All right, well, it may take us a long time for us to figure out what exactly the German government is going to look like going forward. Thank you so much for your insight, Guntram Wolf. He is director of Bruegel. Coming up, key energy issues divide potential partners in a future German government. How will climate politics shape the coalition talks? We'll discuss next. This is Bloomberg Green.
mistakes you've made or failures that you can talk about so that people could feel you're not just a superhuman?
People ask that question as if the only challenge is at work. Challenges come in a lot of different packages.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I'm Jennifer Zabasaja, and here's everything you need to know in green this week. China's oil giants are taking their first steps towards going green by producing more fossil fuels. The country's oil companies are increasing natural gas production as a way to quickly reduce emissions in the short term. That's according to a report by Columbia University's Global Energy Policy Center. China has committed to carbon neutrality by 2060. And Walmart is looking to sell more sustainable debt amid pressure for the retail industry to reduce its carbon emissions. The world's biggest retailer made its debut in the green bond market earlier this month with a $2 billion offering. That was the largest ever from a U.S. corporation. And finally, banks are earning big money from underwriting ESG-related bond sales. Financial institutions have earned about $3.6 billion in fees in 2021 from arranging sales of bonds advertised as instruments of green, social, or sustainable development. That's according to data compiled by Bloomberg. That's more than double the $1.6 billion banks pocketed so far this year from issuing debt for fossil fuel companies. I'm Jennifer Zabasaja, and that's your Green Brief. Kaylee?
Thanks, Jen. Now, it's often been the voices of young people that have pressured governments around the world to focus on the risk posed by climate change. Bloomberg's Ryan Hesketh has been looking at the role that youth climate activists played in Germany's election.
As Germany headed to the polls, one issue drowned out almost all others: climate change. Outgoing Chancellor Angela Merkel promised hope for net zero, but it remains to be seen what path her successors will take. In a year where almost 180 people lost their lives to extreme flooding, this election raised the political stakes of tackling the climate.
Studies are quite clear that the majority of Germans and also the majority of voters from each party are in favor of good and quick climate action. Pretending that there was a lack of will from the public in any kind of generation, that doesn't really match what we know about society. We actually see huge support also coming from some of the industries who are seeing that right now, also in economic terms, it just makes so much sense to be ahead of things, knowing that the least affordable for everyone is delaying action.
Luisa Neubauer has been campaigning throughout the election, watching as climate became a key battleground. The Green Party gained strongly, buoyed by younger voters, Germany's increasingly extreme weather, and mass climate protests.
This election is not just an election for 4 years. This is an election that counts for, almost a century. We see that there are some parties who have a difficult time, accepting that the climate crisis is an immediate threat. And we have others who are kind of further down the road. But at the end of the day, whatever the coalition will be, of course, we won't get to a 1.5 degree pathway. That's why we're mobilizing the public. That's why we ask everyone to not just go and vote, but to also join us on the street, as the pressure is obviously needed more than ever.
It'll be a while before we know the exact makeup of Germany's next government and what approach they'll take to climate. What's certain is the public's demand for action before it's too late.
But the election is not everything. We need people also to pressure political leaders in the future government into places where they right now don't want to be, in a place where they actually commit to 1.5 degree climate action.
Bloomberg's Ryan Hesketh there. The German parties are locked in coalition talks that could drag on for months. The outcome will have a major impact on energy transition policies. All the potential coalition partners agree on the need to decarbonize power, but there's divergence on the best path forward. From renewable energy targets to the Nord Stream 2 pipeline, several stumbling blocks could be in the way of a future government. Let's get into those issues now with Bloomberg NEF analyst Antoine Vanyer-Jones. So let's talk about that incoming coalition, because we don't know exactly what it's going to look like yet at this point. The coalition building is underway. Whatever form it eventually takes, how is that going to impact the energy transition in Germany?
Yeah, that's a great question. So right now, we still don't know exactly what it's going to look like. We have an idea, and there are several potential partners that will play a key role. But when we see how that might affect energy policy, we can break it down into maybe 3 buckets. You have the issues where the cleavages are most clear, and the coal transition, for example, is one of them. There's a coal phase-out target for 2038. The Green Party, a likely partner, wants to bring that forward to 2030. There's going to be some intransigence there, and that's going to be a very decisive issue. On the other hand, you've got the second bucket maybe, which is issues where there's broad alignment in terms of the importance of carbon pricing. Everyone agrees on that. In terms of reducing the energy levy on retail electricity bills, again, broad alignment. The third and maybe most interesting one is where everyone's agreed that we need to build more renewable power. We need to have hydrogen play an important role. But in terms of putting in place the subsidy schemes, the reforms that are very difficult to, for example, set apart a given percentage of land for building wind and solar plants, that doesn't seem like it's going to come out and is going to be as likely. So it's a mixed picture, and that's what's going to make the next few months very interesting.
So in addition to Germany's political considerations in the coalition building, it also, like the rest of Europe, is in the middle of a pretty significant energy crunch. And Nord Stream 2 has been a very difficult political conversation to have really over the past several years. And I'm wondering how that changes given the necessity to get more natural gas into Germany.
So again, that has been at the forefront of many people's mind recently. And really the Nord Stream 2 crisis is one that predates the energy crunch. It's been ongoing for many months now, many twists and turns, and any real guess on the outcome is likely to be very speculative. But what we can say is that it's a bit of a fudge in terms of getting the permits sorted, the sanctions situation sorted. Decisions will have to be made from, for example, the German regulator on what's going to happen. But what I can say is that in a situation where we have high gas prices and we are having supply shortages, that does lend credence and does lend weight to arguments that we need this pipeline to come on now. Whether or not that's borne out by the facts is another question, but in terms of the political argument for getting this sorted in a period over the next few months where there's going to be a lot of negotiations, a decision is unlikely to be taken against Nord Stream 2, well, that's very likely. So we'll have to wait and see. No decision is due for the next few months, but it's something that will be at the top of the agenda for the new government, and one issue that is likely to be quite torn on as well.
All right, Bloomberg NEF's Antoine Vanyer-Jones, thank you so much. Coming up, Germany's auto lobby predicts the shift to EVs could eliminate 215,000 jobs by 2030. We'll discuss the challenges ahead as the car industry looks to decarbonize. This is Bloomberg Green.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can answer phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From Bloomberg's world headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. Germany's car industry is a pillar of the country's economy, but it's been on the back foot in recent years with a high-profile emissions cheating scandal and a struggle to keep up with competitors like Tesla in the race for electric vehicles. Bloomberg's Matt Miller went to the Munich Auto Show to get a sense of the key challenges facing Germany's car industry.
Germany's automakers have been a symbol of the country's economic miracle in the 20th century. But as we move deeper into the 21st century, they've been dogged by international competitors, forced to cut headcount and spend billions to electrify their fleet. German manufacturers like BMW and Volkswagen have almost been dragged kicking and screaming into the electric era after a huge diesel scandal and under very strict EU regulations. Plus, they've been motivated by the giant market cap of Tesla. Germany's political parties also continue to pay lip service to the Green Revolution with bonuses for electric car buyers as well as targets that they've set. For example, the Greens and the SPD now aim for 15 million EV sales by 2030.
Now electromobility is really keeping up the pace, and we are right in the middle of it.
We need time to get electric, because we need the capacities, the plants for the battery cells, and that will take time.
We are accelerating our path towards full electrification, and in fact, we're really going to go for it and see if we can convert our whole portfolio to fully electric by the end of this decade.
Now, electrification doesn't necessarily help with the job cuts. It takes fewer people to build electric motors. One survey says a quarter of the industry's jobs will be obsolete within the next 10 years. But of course, the Green Revolution doesn't stop with electrification. In fact, brands like Audi and Volkswagen believe that the shift to automated driving could be even more transformative than EVs. And they're going to have to add headcount to make that a reality.
Bloomberg's Matt Miller there. And we're joined now for more by Craig Trudell, our autos editor. So, Craig, let's talk about the kingmakers in a potential coalition, the Free Democrats and the Greens. What do each of them want the auto industry to look like?
Yeah, this is going to be really interesting to watch play out. You have a situation where, the Greens were looking like front runners a few months back. They are now in a position of having come in sort of a distant third. They want very different things from what the Free Democrats want. So speed limits on the Autobahns, solar panels on every roof. They want more public transport and bike infrastructure rather than more cars. They're clearly pro-electric, though. And so, this is a situation where we're going to have to sort of square what the Greens want with the Free Democrats, who have a position of wanting to pull back on the very supportive policies for EVs, the supportive but very costly incentives that have helped Germany sort of catch up in the electric revolution. They're leading the way in Europe in terms of the amount of uptake of electric vehicles. But it's a case where, if those incentives are pulled back, that is a huge risk to the consumer that is showing interest in electric vehicles, but doing so in part because of this huge amount of state support.
But are they not going to have to be forced into electric vehicles in the future, given some of the regulations we're seeing, not just in Germany, but Europe more broadly?
Absolutely. That's something to watch as well. From the regulatory perspective, on the horizon, the European Union talking about targeting a phasing out of the internal combustion engine. That's going to be something that the next chancellor is obviously going to play a huge role in sort of determining whether that is pulled off. We're already hearing sort of grumbling from other states like France and Italy as to whether or not they're comfortable going that far. And this has huge implications for an industry that is so crucial to each of those countries.
Well, let's talk about that would-be next chancellor, Olaf Scholz of the Social Democrats. He's traditionally been pretty supportive of the auto industry. Will that change if he becomes chancellor?
I think it's a huge risk, right, to take on an industry that's relied upon for so much employment. So I do think that there's a situation where we maybe don't find ourselves in the old times of sort of the industry being coddled was a word that we've used in a recent story. But we will see a situation where the politicians in Germany understand that, where their bread is buttered, if you will. And it's really, really important that this is managed carefully and thoughtfully, this transition from the combustion engine to batteries, because so many jobs are at stake.
And we can talk about the policy angle all we want, but at the end of the day, it's automakers that are going to be the ones that have to make changes. How prepared are they to undergo this transition?
They're really making a compelling case at this point in terms of how ready they are. They're talking about massive investment in batteries, a lot of product on the way. We just heard from Matt, and at the Munich Car Show, we saw so many electric vehicles that are coming from the likes of Mercedes and VW and BMW. But this is a case where it is going to take some time. While there are a lot of products and a lot of battery plants on the way, they will take years to go up. And this is a situation where, this is going to be both very costly and complicated. The skills associated with putting together a combustion engine don't necessarily translate one for putting together a battery. And so this is going to be very tricky for these companies.
Bloomberg Autos editor Craig Trudell there. So from autos to Nord Stream 2, it's clear climate will be a defining theme of German leadership post-Merkel, whatever the coalition looks like. That's it for this week's edition, but keep the conversation going. Follow us on Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
We didn't want our story to be ended by Taliban. We wanted to continue the path that we started, to continue to go for our achievements and to go for having our dreams to reality. So that's why we decided to leave Afghanistan and go for somewhere safe. We are concerned that what will happen to our home then. Many people are leaving, but there are still girls who have dreams, there are still people who have dreams, and we want countries around the world to help Afghanistan to have peace over there, so that the girls over there can have the opportunities to continue their path as well.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Hi, everyone, and welcome to the Bloomberg special, Price of Power, where we take a look at the ongoing global power shortage. I'm Francine Lacqua here in London. Now, from Europe to Asia, supply restraints from the world's top producers could spell an energy crisis that could upend the global economic recovery. The price of natural gas and coal surges to multi-year highs. The post-pandemic rebound collides with colder months in the northern hemisphere. And avoiding a winter of discontent, governments warn of blackouts, and utilities and policymakers pray for mild temperatures. So European energy markets jump to record highs on signs that the shortage will only get worse as the winter season starts. In Britain, several energy suppliers have gone bust even during the summer months. Soaring wholesale prices made promises to customers undeliverable. Well, the UK government has made it clear it won't bail out failing utilities and has warned of higher prices for consumers.
You would expect normally that the price would revert to the mean. It's not something that we think is going to be sustainable. But of course, Mr. Jones, we have to prepare for longer term high prices.
Well, my next guest is the chief executive of UK supplier Octopus Energy, Greg Jackson. In September, it was announced that Octopus would take on more than 500,000 new customers from the collapsed supplier Arva Energy. Now, to help with the burden, a clean energy investment fund run by the former U.S. Vice President Al Gore has bought a 13% stake in the company. This deal has pushed its valuation to £3.4 billion, more than British gas owner Centrica. Greg Jackson, welcome to Bloomberg and welcome to Surveillance. What are you seeing in terms of the supplier concern right now in the UK? How do you see this extremely volatile and concerning environment developing?
Good morning. Look, the reality is that the UK is no longer energy independent. Like so many countries, it's at the mercy of the global fossil fuel market. And really what we need to do is invest more in renewables so that the price of energy is something that's more in control based on kind of the local physics rather than that global market.
So, Greg, what does it mean, actually, the $600 million investment? Does it enable you to take on more customers?
The $600 million investment is designed to let us carry on the massive work we're doing in research and development for a decarbonised energy system. Today, I'm here at the Octopus Energy Research Centre for Decarbonised Heating, where we are building the technologies to move away from gas and to make electric heating cheaper to buy, install and run than gases.
Do you want to grab market share? Is this an opportunity for Octopus Energy?
I think it's incredibly important to understand the energy revolution is only going to work if citizens are taken on the journey. So what Octopus has done in the UK is, recruited more than 2.5 million customers based on the concept of cheaper green energy with outstanding service powered by technology. We've just taken on, as you said in captions, another nearly 600,000 through the problems experienced at other companies. And I think we now need to take this kind of citizen-led journey to decarbonisation global. So we will take on dramatically more customers directly. But also, we built a technology platform, Kraken, a sort of operating system for renewable energy, which is now licensed to some of the biggest energy companies around the world. And together, I think that's going to build a real platform for change.
Greg Jackson, who's accountable for this? Is it the government's fault that we are where we are? Is it private companies? Like, how can we be, what's happening today, September 27th, 2021?
Yeah. Look, there's a perfect storm in the world of energy at the moment. Post-pandemic, we've seen supply chain issues in so many markets, from silicon chips through to automobiles. Energy's been sort of exposed to the same issues. On top of that, we had long, cold winters in Europe and Asia. We've got depleted gas storage that hasn't been topped up around the world. And then, for example, in the UK, you've got a whole pile of our nuclear power plants offline. So this kind of perfect storm has pushed prices up. What it all does is point to the need for resilience through a more renewables-based system, not just in the UK, but globally, not just for carbon, not just to tackle pollution, but actually to start moving to a much more resilient system to provide cheaper energy for people.
Greg, give me a sense of, what kind of renewables you're going to build. Are you going to build a renewable generation? And if so, where?
Mm-hmm. Yeah, so I think there's a huge opportunity for more wind in particular in the UK. It's a very windy country. Moving towards floating wind is a really exciting opportunity. We've now got community support for onshore wind by bringing people cheaper electricity when they can see the blades turning on local wind turbines. We've got loads of solutions there. And then I think, it's exciting to look at what a globally decarbonized system looks like. The idea of, for example, solar farms in Africa feeding cheap green energy into Europe and helping both ends of that bargain is now looking like a realistic prospect.
Greg, do you think you're moving towards being an integrated utility?
That's a great question. Look, what we've got to do here is what happened with the internet. Governments kind of got the internet going, and then companies were able to take that infrastructure and really transform society through their own initiative, investment, and innovation. We now need to do that with the electricity system. And so, do we need integrated utilities? I don't know. But what we do need is the digital technology, the Uberization of energy, so that we can, in real time, be looking at the generation at every renewable point and then optimizing consumption to match, shifting the points when people charge electric cars or feathering their heating systems to make the most of green electrons when they're abundant and to reduce the need for them when the wind's not blowing.
Great. Thank you so much. Greg Jackson there, the Chief Executive of Octopus Energy, joining us this morning. Now, coming up, we have more on the price of power when we speak to Jeff Curry, Global Head of Commodities Research at Goldman Sachs, and Marco Alverà, the Chief Executive of Snam. That conversation coming up shortly, and this is Bloomberg.
Did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
Reliability matters and affordability matters. And so if costs go up, consumers don't like that. And if reliability goes down, it creates real problems. And so it's one of the reasons that we have to be very thoughtful about changing the mix. And I think what we're seeing in Europe right now is wind and solar are great, but if the sun's not shining or the wind's not blowing, people still need electricity.
Chief Executive of the world's second largest oil supermajor, Chevron, speaking about the energy mix in Europe. Let's discuss this further with our next two guests. We're now joined by Jeff Curry. He's Global Head of Commodities Research at Goldman Sachs. He has been reported as the world's most followed energy guru. That's quite a title, Jeff. He's forecast oil to surge to $90 a barrel if this winter is colder than normal. Also joining us is Marco Alverà. He's the chief executive of one of Europe's biggest energy infrastructure companies, Snam. He's also the author of The Hydrogen Revolution, a blueprint for the future of clean energy. So Jeff and Marco, welcome to a Bloomberg Price of Power special. Jeff, let me start off with you. First of all, we're trying to, exactly understand what's going on. There's a supply crunch. Sure, gas here in the UK is almost impossible to get through, and partly it's, of course, because of Brexit and the lack of drivers. But is this a European/UK energy security problem, and how long can it continue?
Absolutely not. It is a global phenomena, and it's not unique to energy. It's across the entire old economy. Look at trucking in the U.S. These problems were with us long before COVID. We call it the revenge of the old economy. Poor returns saw capital redirected away from the old economy to the new economy. Let me ask you, what do you want to own, a FANG stock or a energy company? The returns in FANGs were much better, so all the capital got redirected to the new economy, choking off the capital that you needed to grow the old economy. Then the COVID surge in demand just exposed all these problems. So it's not unique to Europe. It's not unique to energy. It's a broad-based old economy problem. And the seeds were sowed to this going all the way back to 08-09 when we saw long cycle CapEx shunned in favor of short cycle CapEx. People wanted a quick return, and now you're paying the price for it.
Yeah, the problem market, of course, it touches, spending power. It's people actually that can't afford gas bills. It also means that people can't get into their car, for example, in London, because a lot of the petrol stations are closed. Marco, what does this mean? We're going through an energy transition, right? What does this mean at, having this kind of supply price of power crunch, when people could also blame renewables and saying, look, it's part of the problem that it just happens in terms of timeline at the same time?
Well, I think what's been exposed is the fact that if you have no wind, you can have as many wind farms as you want, but you have an issue. So I'm a believer that hydrogen can be a means of storing that wind energy when there is wind and producing more wind capacity to store in the underground storages that we have energy for times like this. And hydrogen will act as a stabilizer because you can absorb electricity when it's cheap and you can turn it back into electricity when it's expensive. So once we have a lot of hydrogen in the mix and more batteries on the roads and a more stable system that will be relying more on renewables, we will have some bands where if electricity prices drop, you simply produce more and store it. If electricity prices rise, you simply take it out of storage. So that's really what we're missing right now is storage. We have strategic petroleum reserves. We have a lot of oil storage, a lot of oil inventory, but in the UK, there's hardly any gas storage. And in Europe, the storage that we have is half empty. So that's really contributing to a specific European issue. And we're talking about this at the end of September, and we still have the winter ahead of us, which can be concerning in case it's cold.
Yeah, and it looks like it could be a cold winter. Jeff, so why have we not invested more in renewables? And again, we're trying to figure out exactly this relationship between renewables and what's going on right
actually, the one sector that we did invest in over the course of the last 5 to 10 years has been in the renewable sector. Many parts of the world, you've overbuilt wind, you've overbuilt solar, to the point that you've ran power prices negative when they try to get onto the grid, because the focus on ESG investing and being green has saw capital go that direction. It's the old economy. So the new economy is overinvested. The old economy is starved. And again, I want to emphasize gas, coal, oil, metals, mining. You pick the old economy. It is severely underinvested.
But Jeff, what you're saying, there needs in the transition phase, right? These needs to be together. So if we don't have enough wind, and if you have intermittent power, then you need some kind of solution.
Exactly.
So that in between you can fuel it with something.
Right, but the problem is the best fuel for that is gas to deal with the intermittency problem of when the wind's not blowing and the sun's not shining. Now the problem with gas, it is a old economy hydrocarbon-based fuel. It requires investment in E&P companies and the broader old economy, which is, by the way, people want to say this is ESG. I want to emphasize it's bad returns. These companies have not demonstrated good returns for 5+ years. And even if you go back into 10 years, it's been relatively poor. Now, you look at the returns of a Netflix, they're far greater. It's no wonder the capital was redirected. So the only way you're going to see capital go into this sector is you got to get the returns up. You need the prices of these commodities much higher to get the returns sufficiently enough to start attracting capital. Or I guess you can say the hurdle is rising and rising with the green initiative, which means you just got to have higher dirty fuel prices to get the capital to flow. But it is a question of flow of capital, not access.
So, Marco, do you agree with that? There just hasn't been enough, capital going, for example, into gas. And at this point, what can Europe, I mean, we're talking about the whole world, but is Europe at a disadvantage also because of how it's positioned?
We may be a very old economy outlier, but we've been returning capital to shareholders in over 180% over the last 5 years. And we've been increasing our investments over time. And we find because of the very low cost of debt, we do have the capital we need. I think the uncertainty around the future of gas is really what's creating a lot of resistance to invest, especially on the upstream, which is not what we do. And so a lot of projects have been put on hold. It must be said that demand has surprised the markets on the upside. I think no one really factored in how much progress China had made over the last 3 years in substituting coal for gas in people's homes. So China essentially added a market almost the size of the UK over the last 3 years. And because of the reasons Jeff has been saying, investments upstream have been lacking. And so we're in a specific crunch. I'm an optimist over the summer because no one really wants gas in the summer because we use so much of it for heating that we will likely see prices come down very quickly in the summer. About the following winter, we need to invest more in storage. We need more gas storage. We need to do for gas what we've done for oil after the Second World War. Why do countries have strategic oil reserves and they don't have strategic gas reserves, which is a lot more critical because you can reduce oil consumption, you can have different modes of mobility, you can share cars, but you can't share heating when it comes to homes. So we really need to invest in storage. The UK should invest more in storage, and Europe should fill the storages that we have. We have, for instance, in the Ukraine, a lot of storage. And if Europe does it right with the storage, because it has more ability to produce and generate storage because of the depleted fields we have in the North Sea, in continental Europe, in Holland, China doesn't have that ability. China has a lot less geological potential for storage. So if Europe invests in storage for gas, it will help stabilize the global LNG prices, taking in the cheaper summer gas and producing it in the winter, because all the gas consumption is in the northern hemisphere. And if it's cold, it tends to be cold at the same time everywhere in the northern hemisphere. We really don't have summer demand for heating. So that big seasonal swing is something that we need to address with storage, and provides not only cheaper prices, but also greater resilience.
Marco, a question to you both, and actually it's on storage. Is there going to be like a global race now for storage? And what does it mean for prices?
Well, when you think about storing natural gas, it's far more difficult than storing metals or
gold.
Oil or gold or something like that, because you actually need to have old gas well reserves, something like that to put it in. So places like Europe, the storage is very difficult. U.S. and Russia, because they have the old gas fields, have the capability to have large gas reserves. I want to point out, we call this a global energy crisis. There's one part of the world that does not have a crisis, and it's east of Rockies, United States. So from the east, California's got one, but everything east of Rockies all the way to Washington doesn't have one. So you don't hear this noise in the U.S., but it's everywhere else outside of the world. And part of the reason why is because you have massive storage caverns sitting in the east of Rockies in the U.S. So that's the one part that's been avoided. But yes, there's going to be a race, but it's not like oil or one of these other commodities where you can store it easily.
Right. So does it push actually the race towards renewables? And actually, to Marco's point, do they need to be cheaper? Like, how does this transformation take place? Can renewables in 2 years, if we invest enough in them, transplant old fuel?
Well, I think when we look at it, part of the problem that happened that created this initial spike was the wind quit blowing, and you saw a huge surge in gas demand to offset the lack of wind, and that's what created the initial spike. So the key point here is you need that intermittency fuel for when the wind's not blowing and the sun's not shining, and gas is that fuel right now. There's other sources, but I think the key point here, and I think Marco hit on it, is this started with coal going all the way back to China. And this summer, really, it was China that really kicked off these problems. And the problems that we're seeing in growth concerns around China, everything stems from the inability to be able to increase power production. They're cutting aluminum production, steel production, and so on down the line.
All right, thank you both. Jeff Curry from Goldman Sachs, Marco Alverà, Chief Executive of SNAM, both stay with us. Coming up, we continue our conversation with Jeff and Marco. We talk a lot more about the future of renewables and actually where they see the best value in the next 2 to 3 years. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
We are in a debt trap. It's not just fiscal dominance, but when central banks are going to want to essentially phase out unconventional monetary policy, given the debt ratios, there is a risk of a crash in the bond market, in the credit market, in the stock market, in the economy.
Welcome back. This is a Bloomberg special, Price of Power. I'm Francine Lacqua here in London. So we have a viewer question to both Marco and Jeff. Remember, you can send them to us on IB Plus TV Go. I have to say we've been getting quite a few of them, so please continue sending them in. Now, this viewer asks, the IEA is saying that they should not invest in new oil and gas developments. How would it affect the situation we are currently witnessing? So let's get back to Jeff Curry from Goldman Sachs and Marco Alverà from SNAM. Jeff, this is maybe a question to you. I mean, how disorderly is this transition going to be given the constraints on, the old energy and even some on the renewables?
Well, I mean, obviously, it's already disorderly. We wouldn't be sitting here talking about a potential energy crisis on a global basis and the implications that it's having across the globe in terms of growth constraints. Now, in terms of the IEA saying don't invest in oil and gas, yeah, I mean, there's certain investors around the world that will be constrained by this, but I like to point out there's always some investors somewhere in the world that will put capital to work if the returns are high enough. And so the key question is, where is that hurdle rate? Obviously in oil, we're near $80 a barrel. In fact, we're over $80 a barrel this morning on a Brent basis. And if we look at the rig counts in the U.S. and other parts of the world, they're showing you, hey, $80 a barrel is simply not enough. We've been at 75, 79 already. So the question is, where is that number? Where is that hurdle rate? So it exists out there. We're going to find out where it is over the next, let's say, 6 to 12 months. But we know where we've come so far is just not sufficient to get that capital to flow.
Marco, how do you see this developing? Again, how disorderly is the transition? There's a number of also underinvestments in some of the components that, for example, is needed to use in hydrogen to make the price of hydrogen much, much cheaper.
I think it's going to be disorderly and boom and bust, and the investment cycles are going to be a little scattery. But it's going to get really orderly over time, because if we take into account that the cost of the latest solar auction in Saudi Arabia was $10 per megawatt hour, and in Portugal it was $13 per megawatt hour. We now have natural gas at $80 per megawatt hour. So we have this incredibly cheap and getting cheaper renewable energy that's available. And the cost of hydrogen is coming down. We are investing to make it cost competitive with a $50 oil in 5 years' time. That means about $50 per megawatt hour. And the Department of Energy says it can get to $25 a megawatt hour by the end of the decade, which is cost competitive with coal. So once we achieve these numbers, then we have this incredibly potent molecule that we can use to really move and store energy around different time zones, meaning seasons, and different geographies. So we could produce huge quantities of renewable hydrogen from the North Sea, store it in the summer, and use it back in the winter when we need, whether it's going to be heat pumps or hydrogen boilers, I don't know, but we still need this kind of bulk storage. So I think the key for the transition is really going to be centered around the storage and the transport of renewable energy.
Jeff, are you expecting this kind of disruption, to last at least until the winter, or even much longer, given the underlying kind of structural concerns you outlined?
Well, again, I want to emphasize this is not unique to oil and gas in the energy sector. It's going across the commodity complex, and as we've emphasized, this is just the first inning of a multi-year, potentially decade-long commodity supercycle. It's driven by, we have the war on climate change, the war on income inequality. All of these dynamics lead to a structural rise in commodity demand against these underinvestments with this whole idea of the revenge of the old economy. I like to point out in the supercycle of the 2000s, the bull market started in 2003. The energy capex didn't begin until 2006, and the metals capex didn't begin to 2008. So we got a long ways in front of us, and this is just the beginning.
Jeff, thank you so much. We need like a 2-hour-long special with Jeff Curry of Goldman Sachs and Marco Alverà of SNAM. This is Bloomberg.
It's essentially triaging our quarantine response. This is really to support our work in essentially improving our pandemic preparedness. It will be another viral pandemic. We don't know if it's going to be caused by a coronavirus, a flu virus, or an other yet unknown virus. So what's really a sensible strategy now is to develop diagnostics and therapies that can work against multiple different viruses. So we can develop them now, stockpile them now, and then we have them on hand and we're ready to deploy no matter what the next viral pandemic is. So we want this to sense any sort of viral infection, so flu or SARS-CoV-2. So this is just an early way to flag individuals and say, you're a high-risk individual for going on to test positive for SARS-CoV-2. It may not be SARS-CoV-2. You may have a flu infection. You may have something else going on in your nose, but you're at high risk, so we're going to have to send you to hotel quarantine. And then you do the gold standard test and say, yes, actually, you've got SARS-CoV-2, or no, actually, you have a flu infection or you have some other thing going on. It's essentially triaging our quarantine response. We're also identifying individuals that can benefit from early therapies. So if we have an individual who we identify and say, okay, we think probably you're going to be SARS-CoV-2 positive, let's just treat you now. The problem we have with a lot of antivirals is by the time people are presenting to hospital or presenting with the illness, it's too late. So this is again another way where we can early identify these individuals.
it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kayleigh Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
I think that SPACs are very much here to stay.
You can trade anything as a trend follower.
When you think about Bitcoin, I don't think it's a currency. I think it's a commodity.
Today, we're in an everything bubble.
I'm Eric Schatzker, and welcome to Bloomberg's Front Row. Today, I'm talking to the hedge fund hotshots who founded Diameter Capital, Scott Goodwin and Jonathan Lewinson. They invest in credit, everything from investment grade to distressed, making bets on whether borrowers will or won't repay their debts. Diameter is a new breed of hedge fund built for modern markets where speed is the difference between winning and losing.
If you look at how Tiger's disrupting venture with, frankly, speed of capital, or what's happening with Owl Rock disrupting private credit, it's speed of capital.
Speed of capital is really what matters. You don't have time anymore in an environment to sit for weeks and think about it.
Diameter is growing fast, too, from $0 to $9 billion in just 4 years. Scott, Jonathan, and I discuss why they're returning some hedge fund capital to clients, how they've produced some of the best returns in credit, a business plan that gets Diameter to $30 billion, the key themes behind their trades, including ESG. Here's my conversation with Scott Goodwin and Jonathan Lewinson. You guys have built one of the hottest hedge fund businesses on the planet, and you've done it in credit, right? At a time of historically low yields, fleeting distress, zombie borrowers, all in the space of 4 years. How?
Well, I guess that goes back to 2010 when we first met at Anchorage Capital. We worked together beneath Tony Davis and Kevin Ulrich and Dan Allen, who ran the firm. John's background is in research and restructuring, mine's in risk and trading. I think we quickly realized working together that combination of risk and trading and research and restructuring worked really well together versus his background in research and my background at Solomon City in just trading and risk. It was very powerful. And eventually we got to the point where we thought we could do our own thing. He had a little interlude at a different firm. But when I left Anchorage in 2016, we were ready to do it.
What we learned day one is we have very different skills. And we're in an environment where more and more everyone wants to say, you just do this. You do a narrow thing. And what Scott and I love to do is we love to look across the entire credit spectrum, from investment grade to new issue, stressed and distressed. And I come from a place where we tend to do lots of deep value work, thinking about restructuring. Scott came from a place where maybe you held positions shorter. And we realized that, and this is the pitch to investors that got us in business, that there weren't many firms, there are many great firms that do aspects of this, but there weren't a lot of firms that were offering investors a investment in credit. Some years it's investment grade, sometimes it's new issue, other times it's shorting, other times it's restructuring and taking over companies in one package that was large enough to be relevant to banks and advisors, but also small enough to be nimble. And that trading and research, by the way, the personalities don't always work. Sometimes traders and analysts don't like each other. We like each other. I think our pants are even the same color today. That was a key part of it, but offering that trading and research together has allowed us to not only pitch something that worked to LPs, but then make it a reality.
If I had gone to your clients, whether they're institutions, whether they're high net worth people, whatever, back in 2017, and asked them what they thought, I know what they would have told me. They would have said the last thing the world needs is another credit hedge fund.
Yeah. They did. In fact, the joke we made was the world would rather have a global epidemic, we said, than a credit hedge fund. So we should probably retire that now. But yeah, but that's what kind of made it work. What we're doing is a little bit of a throwback. We believe that there are inefficiencies in markets, in trading, and that if you are able to be native across these markets, you'll be able to more quickly understand where the dislocations are. And so in pitching that a little bit of a throwback and pitching a hedge fund, which in many ways was a dirty word. Today we manage a number of different products, but saying we're going to do that. We're going to provide you something that is not as volatile as the markets and that is more smooth. And in down markets, hopefully we do well. Was something they hadn't heard in a while, and we're lucky that some people took a chance.
Maybe we're a little bit more proactive and aggressive in terms of getting research done ahead of events versus reacting to the event and doing the research after the event. but it's combining that trading and research with speed, which we think speed is really alpha in credit. You have a discontinuous market structure. So how do you engage in a discontinuous market structure with speed? You have to know a lot of names. So we have a 20-person analyst team here that many of whom have worked with us previously that help us know a lot of names. And if we know a lot of names and we combine the risk and portfolio management functions, which is what we've done, and that I do a lot of the trading as well, then we can react quickly when a mutual fund needs to sell a block of bonds. Because Fidelity or BlackRock or PIMCO, the big mutual fund complexes, if they might have an outflow and they want to sell, the banks are no longer bidding on a couple $100 million bonds. They're calling us or maybe one or two other counterparties that can react in 5 minutes because we have a proactive process where the research is done up front and we know the names. We can respond in seconds. We don't have to go to the junior trader, then the senior trader, then the junior analyst, then the senior analyst, the junior PM, the senior PM. Layers and layers and layers and layers and layers are frankly bullshit, pardon my French, to make that decision. We can make it fast.
This is a new firm. We only started investing on September 1st, 2017. We have the benefit of taking our skill set and our team's skill set and kind of molding it for the current environment, for the current state of credit markets, for the post-Volcker world, and for the world now post-COVID. Part of what we think separates us from many of our competitors, even though many of them are great, is this combination of knowledge and speed. Speed of capital is really what matters. You don't have time anymore in an environment to sit for weeks and think about it. And in some degrees, you see private equity firms oftentimes wanting to get into credit when it's interesting. But their cultures are set up to be slow because they swing infrequently, and it doesn't always work. We've set up a culture that says, do your work ahead of time. Have a huge amount of work in the preparedness and less amount of process in the decision-making. And that, we think, works with our skills, but also is designed for today's markets and really builds on what we've learned from many people who have come before us.
If you look at how Tiger's disrupting venture with, frankly, speed of capital, or what's happening with Owl Rock disrupting private credit at speed of capital. So all these markets that have discontinuous liquidity, speed of capital matters because most people provide slower capital. If you can provide speed of capital with knowledge, not just provide speed of capital without the research, then you can have an advantage in an environment that's highly competitive.
Now you're returning some of your capital to clients and you're raising fees. How come?
So we'd always size constrain it. We've closed multiple times. We were actually closed when COVID started and we reopened and took money in. But now we're going to return about 10% of the capital at the end of the year, which will bring the fund into the $5 and change billion range from the mid-6s. And we think that sets us up to grow into that capital base again. And if it happens again in the year where the market environment hasn't changed, we'll return capital again. We want to size capital to maximize returns on a risk-adjusted basis. That's something we've committed to our day one LPs. And in terms of the fees, we want to be competitive. We need a lot of people to run our strategy. And we're competing with people who have, frankly, much larger businesses.
Our business, certain of our strategies just don't work if you have to make massive investments all the time. And this idea, when we want people to think about diameter, we want you to think about big enough to be relevant, small enough to be nimble. And the second we feel that nimbleness is compromised, we're not running the strategy that we want to run. It becomes someone else's strategy, and frankly, we wouldn't be as good at it. We have tests that we use, and like anything, it's quantitative and qualitative. Can we move 1% position quickly, long and short? Can we, partnering with banks and issuers on new issue is an important part of our business that we can get into. We don't like using leverage, and so we like doing a lot of new issue in bull markets. Can we get enough of that for the fund size?
Bloomberg surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
you
drop
great.
the bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has to go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
Some people I know are baffled by your returns. They say there's nowhere near enough ways in credit today to generate that much alpha, especially running as little leverage as you do. So what's the secret? How does the magic happen?
So, I mean, it's knowing the names first, right?
You really believe that is, well, that's a dividing line between you and others?
Everybody can know the names, okay?
But no, not everyone does.
But knowing them early and knowing a lot of them versus knowing them after they go down. Think about it. Most of credit is rules-based. You have investors who either have a ratings constraint, a duration constraint, or a liquidity constraint.
Mutual funds, for example. Mutual
funds, others, CLOs, right? We manage CLOs. They have tons of constraints on them, and we abide by all those constraints. But if you have a universe of names you know, and then you can apply that to all markets, investment grade, levered loans, high yield, stress, distress, structured credit, at any given time. In 2011, it was Meredith Whitney blowing up the muni market, right? And be agnostic to where you go on a risk-adjusted basis and be fast because you have a trading mentality that is in your portfolio management process. That's what differentiates it. And it's in this environment, like people are going to say again, there's nothing to do in credit, right? Diameter's returning capital, but there is stuff to do. We just think we want to size our core hedge fund product to do it well. What is there to do right now? Well, you had a pandemic, huge recession. A lot of companies did very poorly for 6 to 12 months. Now they're doing well. Some are having record earnings. Enterprise values are higher than they were pre-COVID. Those companies that were junked are going back to investment grade. There's an ARB because when you go from BB to BBB, the number of buyers, the universe expands exponentially. So if you own the company as BB and you think that S&P or Moody's is going to upgrade it, like Netflix is a position for us right now that we think will get upgraded, there are going to be more buyers of Netflix and those bonds will tighten. And maybe that isn't a money multiple opportunity, but it's a high Sharpe, high IRR opportunity. Capital markets. There's record M&A right now. We have capital markets bankers calling us, asking to lay off risk because they want to do more deals. So A, we can help them lay off that risk. We can participate in those deals, learn new names. Those are the opportunities. And credit dispersion was record lows first half of the year. Now it's starting to come back.
You looked skeptically when we said know the names. Why can't everyone know the names? It's an efficient market. You can't, think tanks don't work in finance. By the way, I don't know that they work that well in Washington, but that's again another story. Think tanks don't work here. So if you don't have a mandate to buy investment grade bonds or to buy new issue high yield bonds, you are not going to know them. If you don't have a mandate that includes shorting businesses occasionally, you're not going to know businesses that are in the decline. So when the crisis hits, whether it's oil and gas collapsing in 2014 or 15, or it's even at the end of 18, when there was a scare on interest rates and the market sold off, or of course the global pandemic that we went through. If you haven't invested in the names previously, you're not going to do it again, because what do people do? When you are afraid, when the market sells down, unless you're a total psycho, unless you're the guy in Free Solo whose brain is different than the rest of us, you're going to be afraid too, right? Because the market is trading off for a real reason. There is a global pandemic. Okay, so you're not going to buy something you've never heard of. You're going to go back to what you know. But if you've only been looking at crappy companies, let's say that's your mandate, then you'll buy things that went from 75 to 50. We think oftentimes they go to 0. So it's our mandate of always looking at a lot of things, not having a think tank, always finding ways to invest in it with one team that allows us to constantly find what Scott talked about, the return available in credit.
What are you 3 years from now, 5 years from now?
Hedge fund, $5 to $7 billion. CDOs, $1 billion to $1.5 billion. Because there's a cannibalization effect there with the hedge fund, so we size constrain that business. CLOs in the U.S. 8 to 10. CLOs in the U.S. in Europe, maybe 2 to 3. Structured credit, long only business potentially. That's a couple billion. And then we think about what's happening in markets, and we want to adapt our business. And we think that eventually private credit's a business that we'll be in. I'm not going to put a size on it. But we see what the private equity guys are doing. We're getting more and more calls from them, especially on second liens, where we've worked a lot with Thoma Bravo, for instance, to originate a second lien paper with them. We think that there's a real convergence in the credit space that we focus on, not the really small cap stuff, but mid and large cap, where we'll have an opportunity to be in that business as a complementary business to what we're doing elsewhere.
If I add all those numbers up together, it's big. I get to north of 20, maybe 25.
Yeah, 30, maybe. Yeah, we'll see. But you're only as good as your last trade. We got to keep making money in our core products first, and the other stuff will come along.
4.5 years ago, we were in a windowless room. We remember that every single day.
Have you thought out a strategy yet for private credit?
Whether we do it in a small scale or a large scale, we're still discussing, but it's a business that you'll see us in over the next few years because it's really synergistic with what we're doing, and we want to provide those capital solutions when issuers, companies come to us and they say, well, we want a private and a public solution. We want to be able to provide that, whether it's working with the banks or working with the private equity sponsors that we do a lot of business
And we
with.
want to know more names. And so it's not something that was on the page, though, to your point. 5 years ago in Bubbies, we're not thinking that way. The market is changing, that dynamic is changing. CLOs are growing like crazy, so there's people need public paper too, but that's why we're thinking about it.
You have to adapt, you have to be nimble, and the market's telling us right now that that's a business that we eventually need to be in.
I want to ask you about regulatory issues. Gary Gensler, the SEC chairman, is turning his withering gaze on corporate bond trading. He told senators he wants more efficiency and he wants more transparency in what historically has been an illiquid and opaque market. What could he do?
That to make the credit market look a lot more like the equity market would be a massive, massive overhaul. Doesn't mean that you can't do things to bring it closer and to protect investors who are today not being appropriately protected to the extent that exists. But I think it also highlights a really important difference. Scott mentioned it earlier. Credit investors are generally rule-based investors. You're looking at what's the rating, what's the industry, what's the geography. And certainly there are rules-based investors in equities to some degree, but it's such a different product. Equity markets forcing you to think so much forward-looking, whereas credit markets oftentimes are thinking, what were the last 12 months' earnings? That there are probably really good ways to reform credit, many of which we haven't even thought of, that don't necessarily say just copy what you see in equities.
You go long and short in the hedge fund. Mm-hmm. Do you think of shorting as a hedge or a source of alpha?
Shorting is controversial. My dad was an equity research analyst, and he used to say to me that shorting is un-American to some degree. He's an investor in the hedge fund now, so maybe he's come around. But we really believe that so much time, so much on television, is thinking about who are the winners, right? Who's going to have the best payment app? Who's going to have the best electronic vehicle? And a big part of what we offer investors in thinking about shorting is sometimes finding the losers is easier, and finding them before it happens in capital structures that are hard to move around. And so we really think that building our business to think about where is there technological transformation, where is there policy volatility, and where is there a lot of debt? First it was oil and gas led in terms of debt, then healthcare led in terms of debt. Now I think it's technology that learns in terms of issuance. Basing our business around that to learn those companies not only produces a return shorting, but we turn around a lot of times and then buy them later when they're at a lower dollar price and help fix the businesses or work with people to fix the business.
We've had too many shorts the past year. It's certainly been a drag on our returns. Our drawdown fund, which is long only, has done much better than our hedge fund. But we're starting to see price volatility come back. And maturities change things. So there are certain sectors we think, like airlines, have been zombified by what's happened over the past year with all the bailouts there, and some of those capital structures. Over time, will have problems. There's nothing obvious right now, but you have to, when you're shorting, what are you playing for? Are you playing for a downgrade, earnings miss, a default, right? You have to know what you're playing for and size your position to be able to trade it accordingly. But right now, you're not playing for a lot of defaults, and we don't have a ton of shorts right now, and they're very concentrated in the industries and sectors that we think have been, more zombified by COVID.
You believe in shorting. It's part of the capital market, right?
Yeah, sure.
Do you worry at all that the meme stock vigilantes could turn on credit players like Diameter and make you pay a Melvin-like price for having negative views?
It was something that no one thought could happen. It happened. And so we've now thought about it deeply and are more worried than we were.
you have any mistakes you've made or failures that you can talk about so that people could feel you're not just a superhuman?
People ask that question as if the only challenge is at work. Challenges come in a lot of different packages.
Who are U.S. Open tennis champion Emma Raducanu's 3 dream dinner guests?
Daniel Ricciardo, Michael Jordan, and Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
What are some of the big themes informing and underlying your trades right now?
The world is dealing with huge questions, but they're much longer term with a much broader array of outcomes. We're now learning that COVID is probably going to be something that is going to be with us in some form. We're learning that the vaccine efficacy changes over time, and you may need boosters or not. We are seeing that China is upsetting a lot of the expectation in markets as it changes some of its approach from economics to politics. We're seeing our politics at home. We may have a rerun of the 2020 election in 2024. And we have a central bank that has been really arguing since June to think about quantitative easing and rates and inflation differently. The problem is you don't get quick answers. Last year was unique. We got quick answers. All of those play out over 18 to 24 months. And I didn't even mention the fact that what happens to stimulus that the market is really addicted to if, for example, the control of the Senate changes in 2022. So what we think that leads to is a more tactical market, harder to sit there and say, I believe this. Also, 2 years of COVID, there may never be a new normal in terms of work from home and business travel. And so we're spending a lot of our time, looking at economic data. We're not macro traders or investors, but everything we do starts in what is the macro of the economy? What is the macro of the industry? What do we think about different types of consumers? How is spending going to change? Where is pricing going to really affect? And a lot of the themes we're focused on are how much of the inflation in goods is transitory versus real. We think generally that over time supply chains work themselves out, but that services inflation is much harder to give back because once you've raised wages, it's harder to go back. And so some of those themes, which we then apply to industries like airlines and commercial real estate and hotels, where we see paper available and see some distressed, that's how we go from that 30,000-foot macro down to the company, but it always has to start with a view on the economy.
Many in the markets are terrified by the prospect of a taper tantrum. Are you?
Oh, I'd love it. I mean, we might lose money at the beginning of it, but we have our watch list, we have our process. Each analyst is ready. We're disappointed there hasn't been one yet. And I think that would be a great opportunity for us.
Because
what we'd rather do than do distressed or grind out returns in Netflix getting upgraded, frankly, is buy really good performing risk at a discount to par. And taper tantrums, 2013, created an opportunity like that. It was there for maybe 3 to 4 weeks, and it was gone. We really like those opportunities. You had a loan market type tantrum when the Fed changed its policy at the end of 2018. Loans went down 5 points. We put 15% of the fund in loans in like 2 weeks. So we'd be excited for that opportunity set. But again, people have been predicting that all year, and it hasn't happened. So positioning for it, are you going to be positioned exactly right for it? No. And then you have to be able to change. So what does being able to change mean? We better run a low gross right now, which we are. Our gross is close to as low as it's been. We don't run a lot of gross because we have more trading velocity, and especially periods like now. We're sitting and being more patient. We're not patient people, but now it's kind of a time for patience.
Scott's excitement jumping off the page there goes a little bit to where we're different. So if you think about a taper tantrum, you're saying high quality bonds trade down. They don't go to distress levels. They go from par to 90, from 98 to 88. That would be an environment where big distressed guys would not be interested yet because these companies aren't defaulting. They're down for technical reasons. And they would look at the yield and they say, well, this doesn't hit my yield bogey. Whereas performing credit people might be having outflows because the retail market might react and say, oh, wow, bonds are going down, I want out. There are not a lot of, we've set up the firm to be at that intersection, to be able to buy the highest quality stuff when it's down, and that's represented by a taper tantrum.
You've committed to not invest in thermal coal, guns, and tobacco.
Yeah, no longs.
Why?
I mean, we're trying to respond to our investor base, which is, frankly, I think ahead of the curve. versus the hedge fund industry on ESG. And we've got some really thoughtful investors that we're working with, not only in the hedge fund and the drawdown fund, but in our CLOs, which have even more stringent ESG policies so far than the hedge fund does. We don't think that we should be supporting and financing companies that have negative long-term impacts on society. And ESG is really interesting because it's probably going to be something that changes cost of capital for companies for the next 10 years. It's going to be a huge changer of cost of capital.
We'd love to say this is just driven by our moral ideals. It plays a role. But as Scott pointed out, the market is no longer going to provide capital to restructure these businesses. The number of regular way investors, particularly investors higher up in capital structures who don't want to take a lot of risk, they want to be able to say, I'm not taking a lot of risk, I don't have a lot of return, so God help me if I'm helping a company that's destroying the environment or doing bad things to people. So we think that we're getting a little bit, trying to get a little ahead and saying, not only do we want to do the right thing, but the cost of capital is going to change dramatically for these businesses, and don't think about your old valuations when you think about some of these dirty companies.
And we're going to have to make our money shorting them because we're not going to be investing in the distressed when they go distressed.
But you're in the money-making business, right? As the cost of capital rises, the return to the investor in that issue, whether it be equity or whether
it keeps rising, right, keeps getting worse. A lot of the thermal coal, in many ways, people tried. They said, oh wow, look how cheap this is. Right? And then they realized there's just a whole generation of people who don't want anything to do with it. You're going through in Europe a little bit of an issue with power right now, and coal plants are slated to close in the UK, and you don't see a huge uprising. You say, what are we doing? The world has moved on a little bit. You can assume maybe that the cost of capital might change and go back down for some businesses, but for others we think it's a rise upward.
We have a surge in demand. As you know, we had a lot of fiscal support, and that's, we've passed the peak, and that means it will also fade away.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Leaders from around the world convene in New York City for the UN General Assembly.
Distinguished delegates, please take your seats. The third plenary meeting of the General Assembly is called to order.
To discuss the biggest problems facing their governments.
I'm here to sound the alarm. The world must wake up.
Will we meet the threat of challenging climate already ravaging every part of our world?
The world has entered a period of new turbulence and transformation.
We have an awesome power to change things, and to change things for the better. We have to choose. The world has to choose what kind of awesome we're going to be.
Welcome to a special report, Bloomberg New Economy, Leading Through Recovery. I'm Anne-Marie Hordern. World leaders gathered for the 76th United Nations General Assembly in New York City after going all virtual in 2020. Nations discussed and debated some of the most difficult challenges of our time: an ongoing COVID-19 pandemic, extreme weather events brought on from climate change, and growing economic inequality.
Challenges are not in short supply. Fragility, conflict, COVID-19, climate change, the list goes on.
We are on the edge of an abyss and moving in the wrong direction. Our world has never been more threatened or more divided. We face the greatest cascade of crises in our lifetimes.
In my view, how we answer these questions in this moment, whether we choose to fight for our shared future or not, will reverberate for generations yet to come. Simply put, we stand, in my view, at an inflection point in history.
We must show that we are capable of learning and maturing and finally taking responsibility for the destruction we are inflicting, not just upon our planet, but upon ourselves. It's time for humanity to grow up.
We must revitalize the economy and pursue more robust, greener, and more balanced global development.
We have brought forward from 2060 to 2050 our goal of achieving climate neutrality, net zero.
Korea will scale up its climate ODA and set up a Green New Deal Trust Fund with a view to supporting the work of Global Green Growth Institute.
China will strive to peak carbon dioxide emissions before 2030 and achieve carbon neutrality before 2060. China will step up support for other developing countries in developing green and low-carbon energy and will not build new coal-fired power projects abroad.
As leaders discuss curbing the environmental impact we as a civilization are having on the Earth, a devastating report by the United Nations showed that we can no longer stop global warming from intensifying, but we still have a small window to stop it from getting even worse. U.S. Special Presidential Envoy for Climate John Kerry said that China must move quickly to lower greenhouse gas emissions and turn away from coal power to limit the worst consequences of global warming. Kerry spoke with Bloomberg's David Weston.
There's been a lot of talk. What actually has gotten accomplished so far? What specifically has gotten done?
I think more countries are becoming aware they've got to step up their game before we go to Glasgow for the Conference of the Parties meeting. We also have had the United States, President Biden, put on the table a doubling of the amount of money that the United States will do in terms of the $100 billion total that has to be put together. China announced yesterday they will no longer fund coal externally in other countries. So people are taking steps. People are beginning to build some momentum, I think. The question is, will it be enough?
So, as you say, President Biden doubled the commitment from the United States toward the $100 billion. Is that enough? Because I've seen some estimates that say that actually it should be more like $40 billion should be the U.S. share toward that $100 billion.
Well, they doubled the doubling, and I think everybody understands that we have a complicated Congress right now. I think it's what the market will bear. But it's also a significant increase of the United States effort. I mean, President Biden is putting more, about $11 billion plus on the table And that's an important contribution. Other countries need to also do their part.
Beyond President Biden's commitment of $11.4 billion, you also referred to President Xi having sent a statement to the General Assembly about coal-fired plants and stopping the export of them from China. How far does that go toward what you asked for? You asked him for that, as I recall.
Yes, we've been talking about that since way back in January when I first had my first meeting. This is one of the first issues we raised, is the need to end the foreign finance of coal, the foreign investment of coal. Why? Because as of yet, there's no means of really having clean coal, and it is the creator of the greatest amount of emissions in the world, unabated. It is as it is in many other countries. So the last thing we needed was any country that's going out and pushing new coal-fired power plants. We have some in America still. We have some nuclear plants in America still. We have 20% of our power in Massachusetts comes from nuclear. Nobody's saying close that now, or nobody, I think, absolutely rational with respect to what the choices are. But we cannot continue to pour emissions into the atmosphere, which only heightens the level of the damage being done. The best scientists have told us we have now about 9 years within which to make the critical decisions and implement them to avoid the worst consequences of the climate crisis. That's what we have to do now.
That was U.S. Special Presidential Envoy for Climate John Kerry, and other leaders at the forefront of this battle spoke to Bloomberg about the impact of climate change, including Alok Sharma, COP26 President, Greek Prime Minister Kyriakos Mitsotakis, and UN Secretary General Antonio Guterres.
We are on the verge of a disaster, and there is a risk of a failure for the COP26. If you look at the last data that was published by the Intergovernmental Panel on Climate Change, it was clearly stated that things are getting worse than what it was forecasted, and that we have truly a code red in relation to climate evolution. Either countries understand that we are on the verge of a disaster and change course, many of them, others have done a lot and we have to recognize that, or we risk to have a COP26 that fails and we need to face a catastrophic situation in relation to climate. And I believe that this meeting is a very important meeting for a wake-up call with heads of state and government of developed countries, to make sure developed countries are able to correspond to the commitment made to provide financial and technical support to developing countries, namely the $100 billion per year that should be provided. And also the understanding that the impacts of climate change are so devastating, namely in the developing world, small island development states, African countries, but even in the United States, let's be clear, the impacts are so devastating that we need to have half of the climate finance for adaptation to build resilience of the communities, and for the moment it's only 20%. So there are clear requests to developed countries, and also let's be clear, also emerging economies need to commit to more. Need to be part of the reductions program. And until now, many emerging economies have objectives that are not ambitious enough.
The American forest fires are time zones away. You have a fire recently 13 miles, 18 miles from Athens. You are living fires. You are living record of heat. What do you need from Europe? What do you need from world leaders to jumpstart the climate change debate?
First of all, this is really happening. I'm not talking about climate change. I'm not talking about the real climate crisis.
And the energy, fold it right into energy.
That is hitting especially the Mediterranean very, very hard. Now, we've put in place a very ambitious plan to decarbonize very quickly. And Europe is at the forefront of this effort. As you know, we have a commitment to be climate neutral as a continent by 2050 and to reduce our greenhouse gases by 55% by 2030. What are we doing in Greece? First of all, we're shutting down all our coal-fired electricity plants. We said we would do it by 2028. I think it will be possible to do it by 2025. So we are significantly contributing towards decarbonizing by changing our energy mix. Obviously, we're adding renewables. And in the interim, we are going to be dependent on natural gas. We're retrofitting our buildings at a very rapid pace. We are putting in place a very ambitious plan to encourage people to purchase electric vehicles. And all that is supported by European funds.
Here to talk about the most significant climate event since the 2015 Paris Agreement is the man behind all of the preparations, Alok Sharma, COP26 President designate.
Over the past year, I have spoken to well over 100 governments. I have made visits around the world, including to China. My friend John Kerry, of course, has also done the same. And I can tell you from all the conversations that I've had is that countries around the world recognize that climate change is a great leveler. It does not recognize borders, and they can see themselves what is happening in their own countries. This isn't just about something that's happening internationally. This is happening in the nations around the world. So they see the reason why we need to work together on this. When I was in China, I had a constructive but very candid set of discussions with colleagues in China, and I made the point to them that they have set out clear ambitions. President Xi Jinping has set out clear ambitions in terms of reducing the use of coal. He's set out ambitions in terms of carbon neutrality, getting to the point where they peak their carbon emissions. What we want to see are two things. One of the detailed policies that deliver on these commitments, and the second, and this is really important, are those commitments in the near term, the 2030 emission reduction targets that every G20 nation, indeed every nation in the world, needs to come forward with. But I think particularly the biggest emitters need to set those out before COP26.
Leading through recovery takes innovation while looking for solutions. Ireland's Prime Minister, Michael Martin, discussed how his country is dealing with climate risks with Bloomberg's Caroline Hyde.
Talk to us about net zero by 2050. Will Ireland achieve it?
Yes, and we've passed a climate law in Ireland, which sets very ambitious targets of reducing emissions by about 51% by 2030 and net zero by 2050. And that is a very strong commitment of ours across every sector. And by the end of the year, we will be publishing carbon budgets for each individual sector, from transport to agriculture and to industry. And we have to move fast as a country, and we have set very challenging targets, but we are absolutely determined with our European Union colleagues to achieve them.
Coming up, fighting the COVID-19 pandemic around the world.
What we need is a global vaccination plan. And to have a plan, we need to have leading that plan those that have power. And those that have power are the countries that produce vaccines.
That's ahead on our special report, Bloomberg New Economy, leading through recovery.
Dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that of course is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
Welcome back to our special report, Bloomberg New Economy, Leading Through Recovery. The World Health Organization urged leaders attending the United Nations General Assembly to guarantee equitable access to COVID-19 vaccines. The WHO said vaccinating 40% of every country's population by the end of 2021 and 70% by mid-2022 is achievable with genuine commitment to vaccine equity. Bloomberg's Tom Keene and Kayleigh Lyons spoke with the president of the World Bank, David Malpass, about COVID inequality.
It's $7 a dose to get a vaccine. Why can't we vaccinate Africa?
Yeah, this is on everyone's mind, and it's frustrating. The excess in the advanced economies. I'm chair of a task force that includes IMF, WTO, and WHO, and so there are 2.4 billion excess doses in the advanced economies.
Wow.
So
wow.
The goal would be to have those early doses, the early deliveries, go to developing countries where that can use those particular doses. You know, it's a hard logistics problem because you've got to get the dose from the factory to a country that wants that kind of dose. So some want mRNA doses, some want AstraZeneca, some want J&J, and so on down the list. And then they sit in a warehouse and they're not applied to people. And that, I think, has to be improved. We're urging, and the task force is urging, the advanced economies to allow a swapping of doses. So if they have a delivery scheduled into their warehouses in October of this year or November of this year,
right.
allow that dose to go to a developing country person and take a later delivery schedule because you don't need it. You've got excess 2.4 billion doses.
Yeah, David, it's an excellent point. We're having a conversation now about boosters here in the U.S. when there's many people throughout the world who have yet to receive their initial dose. Do you need the Biden administration to take more leadership on that?
Hi, Kayleigh. You know, I think the world has to come together and find solutions to this problem. And the boosters countries are going to want to do that as needed in order to protect their population. That still leaves huge amounts of excess doses, even in near-term deliveries. What we're working on right now is trying to get November and December deliveries scheduled so that the countries can prepare to deliver that kind. You need a specific kind of cold storage or of trained personnel on each kind of vaccine, and we need much higher numbers of vaccinations in developing countries, and especially the poorest countries.
With the pandemic still spreading throughout the world, booster shots in wealthier nations have become a controversial topic. Ecuador President Guillermo Lasso, Austrian Chancellor Sebastian Kurz, and UN Secretary General Antonio Guterres says to solve the problem, we must come together.
What we need is a global vaccination plan. And to have a plan, we need to have leading that plan those that have power. And those that have power are the countries that produce vaccines or can produce vaccines if they have licenses and technical support for that, to bring them together with international financial institutions and the World Health Organization, able to deal with the pharmaceutical industry and then solve the problems, intellectual property and others, and of course paying what is needed, because obviously the pharmaceutical industries are not philanthropic organizations, we know that, but to have a global vaccination plan which implies doubling the production capacity, which can be done. We see AstraZeneca produced in different places. I believe even Pfizer now made an agreement with a country to produce there. So, but this can be done systematically. Wherever there is a capacity to produce vaccines, vaccines should be produced, and conditions should be created for that. And doubling the production of vaccines, and then having a mechanism of distribution that is equitable. That's what we need. Of course, we have all the problems that we mentioned and many others of the present situation, but these are all small aspects of a bigger one. And the bigger one is we cannot deal with this with vaccine nationalism or vaccine diplomacy, or we need to deal with this with a global vaccination plan and bring together all those that have the power to solve the problem.
But do you think there is something problematic about the booster shots that are now spreading throughout
I'm
the
not a technician, of course. If to have booster shots in one country means that others will not have shots, of course, this is not the best way to deal with the disease. If the booster shots are not used, and then the vaccines go to the as we have seen in many things, to the containers of garbage, then of course the problem is different. But the central question is we need a global vaccination plan. We need to double the capacity of production that exists today and to have a mechanism of equitable distribution, and those that have the power related to this need to come together.
This diplomacy started from a fundamental idea. Health has no ideology, and as soon as I won the elections, I met with the ambassadors of the US, China, Russia, and the European Union to address the need to obtain vaccines. And we were successful with the collaboration of the United States, China, and countries such as Spain, Canada, and even countries like Chile, with a small donation.
Unfortunately, we still have the situation that many countries do not have enough vaccines, so not all the countries are present here at the moment. And my main focus is still on the fight against the pandemic. I think we have to support all the countries in need through COVAX and other initiatives so that we are able to fight the pandemic worldwide and not only in the rich countries like the US, Europe, and some others.
Coming up, to fight the world's most urgent crisis, we must come together. But can it be done? That's ahead on our special report, Bloomberg New Economy, Leading to Recovery.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We're not seeking, say it again, we are not seeking a new Cold War or a world divided into rigid blocks.
It's not the time to blame the others. It's the time for everyone to do everything possible to assume their responsibilities.
I'm confident the United States and China can reach agreement on some tricky economic issues. We've done it previously. I'm sure we can do it now, and we've got a good team poised to have those discussions.
We're now joined by Bloomberg New Economy editorial director Andy Brown. Andy, we heard from Biden talking about we're not on the brink of this cold world, and he said, let me say it again. But many would disagree.
Well, it certainly looks as though we're on the brink of a Cold War. The sale of U.S. nuclear submarines to Australia recently, I think, demonstrates that the U.S. and China are locked in geopolitical competition right now. And I guess one of the big questions is whether or not they can transcend that competition to work together on some of these big existential issues, of which by far the most important is climate change, but also control of pandemics.
And Bloomberg will be hosting the New Economy Forum in Singapore. What's the expectation?
It's interesting that the conversations that have been swirling around New York during United Nations General Assembly Week are very similar to the kind of conversations that we're going to be having in Singapore. And fundamentally, these conversations are linked to the whole issue of a collapse in global trust as a result of the COVID pandemic. Trust is at an all-time low, and that's the implication of some of the comments that we just heard from global leaders, including the United Nations Secretary General. Trust between the developing South and the industrialized North, trust among countries, trust in global institutions, trust by populations in government to do the right thing when it comes to climate change. And, you know, one of the most dramatic, tragic manifestations of this absence of trust is the fact that, yes, we are talking about booster shots for vulnerable populations in rich countries when you have a continent the size of Africa that is still largely unvaccinated. That's the kind of gap that leads to this shredding of global trust.
An absolute deficit. And the WHO wants to put a moratorium on boosters until there's higher numbers in these developing world. So how do we fix it?
Well, that's the topic of really, that's the theme that's going to be running through our deliberations at the Bloomberg New Economy in Singapore. And we're going to be looking at it through the prism of supply chains, technology, of global institutions, of data, the capital markets. But most importantly, to get back to this trust issue, how do we rebuild international trust? Look, you know, in the absence of trust, absolutely nothing gets done. So, you know, bringing together leaders from developing countries and developed countries to talk about this problem, to reestablish habits of cooperation, to figure out how you can get the world collaborating, uniting against climate change, that really is the essential work of our forum.
Andy Brown, thank you so much for your time. You've been watching a special report, Bloomberg New Economy, Leading Through Recovery. I'm Anne-Marie Hordern.
We didn't want our story to be ended by Taliban. We wanted to continue the path that we started, to continue to go for our achievements and to go for having our dreams to reality. So that's why we decided to leave Afghanistan and go for somewhere safe. We are concerned that what will happen to our home then. Many people are leaving, but there are still girls who have dreams, there are still people who have dreams, and we want countries around the world to help Afghanistan to have peace over there so that the girls over there can have the opportunities to continue their path as well.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I am waiting eagerly for that ultimate approval so that our children
can get vaccinated so that we can do all we can to navigate through this COVID-19 pandemic.
I would say the best wealth managers in the world do much more listening than they do talking. You should never invest in something that can't be simplistically explained to you. You know, the most important thing is to be able to save early, and if someone can be there to help you through that, you know, that's one of the most important things.
When it comes to wealth management, Mary Callahan Erdos is best in class.
Mary was a student in my class at Harvard Business School. There was something about her in that class where when she spoke, people paid attention, people listened.
From Harvard Business School, Mary made her way to Wall Street, joining JP Morgan in 1996.
Yeah, it was like a rocket. It was just fascinating to see her grow.
Mary became CEO of JP Morgan's asset and wealth management businesses in 2009, and under her leadership, client assets in those divisions swelled from $1.6 trillion to $4 trillion. And she's expanded the businesses into new markets everywhere from Las Vegas to Amsterdam.
When you were growing up, did you say, I want to manage $4 trillion when I am an adult?
I wish I had had that clairvoyance back then, but no. My first foray into the money management business, as has been retold to me, is my grandmother asking me to balance her checkbook. And she actually paid me a couple of dollars every month to do that. And one day she said, I think you need to get a real job, and sent me downtown to the city of Chicago to look for a job. I found one in the mailroom equivalent of Steinrow & Farnham, which was an investment management house. And the mailroom equivalent was a computer room where you ripped off the pieces of paper for the big portfolios, and then you walked the different floors and you delivered them to people. And over time, a few of them took interest in explaining to me what I was delivering to them every day. And the rest is history, really. I mean, that's when I fell in love with markets and understood that every day it was different, that all of them managed portfolios in a different manner. And I also learned about the concept of overtime, so that was pretty cool too.
Okay, so now you've been at JP Morgan for about 25 years?
Yes.
Okay, so, and now you run one of the most important parts of JP Morgan, which, as I say, is the asset and wealth management business. For people that aren't that familiar with wealth management, what actually is wealth management, and how is that different than asset management?
Great question. The two are often used interchangeably, but they have distinctions. Asset management business is where we manage money on behalf of individuals, institutions, sovereign wealth funds, pension funds. We manage them in mutual funds, we manage them in ETFs, we manage them in single stocks, single bonds, hedge funds, private equity, and the like. And that is the heart of the fiduciary business that we run here at JP Morgan. Wealth management is that plus understanding someone's entire balance sheet. So for the individuals where we manage money, we also help them with their mortgage. We help them with a loan that they might need. We help them with their basic credit card. And so wealth management is trying to help someone with their entire life, both their assets and their liabilities, their planning, their gifting, the legacy that they want to leave for their families, the 529 plans they need to prepare to get their kids to go through college. And it's a great insight into people's, entire journey.
Now, many organizations like JP Morgan have wealth management businesses. Some are bigger and some are smaller, but basically you're managing money for and doing other things for wealthy people, more or less. Is that fairly right?
For wealthy people, although, many of the successful wealth management firms today have figured out how to take all of those great learnings for what they do with very wealthy people and also package them for people who have their first paycheck and they want to be able to save a little bit of money, or want to have access to things that maybe they wouldn't normally have. And so we've been able to take things like what we do for a super wealthy family, package it into a bite size where you walk into a Chase branch and you're able to get some of the same advice. And so I think it's opening up the world to be able to help people. And the most important thing is to be able to save early, and if someone can be there to help you through that, that's one of the most important things. If you look at, an average investment
in the world, if you just look over the past 20 years, take a balanced portfolio, it's about 6.4% average annual return for people that generally manage money. The problem is most individuals' actual return is less than 3%. So it's less than half of that. Why? Because they make emotional decisions when markets are one way or another. They get caught up in the hype of things. And so it's super important to have that advice as early on as we can give it. And I think, you know, that's the rewarding part about this business, is being able to try to help people through all of those different journeys that they have.
But what you're saying is that the average person, if he or she says, I'll manage my money myself, I'll save some fees that I would pay to JP Morgan or somebody else, that person generally is either selling at the wrong time or buying at the wrong time, or at least they're not getting the returns that they could get if they had a professional manager helping them. Is that what you're saying, more or less?
Some people are very successful investors in their own right. You know, the way that I've seen it over the 25 years that I've been doing this is most people make great sums of money by doing one thing really well. And when they master that one thing really well, like maybe running the largest and most successful private equity firm in the world, nobody can beat them at that. And that's the way they make their money. Then to keep their money and continue to grow it, the trick is diversification. Diversification comes with having to master lots of different things. And generally, people find it hard to master lots of different asset classes, sectors, countries, areas to invest, because they don't have the time to do that. And so being able to get other people to help with those components, maybe it's just the ones you don't master, maybe it's all of them, maybe it's components of that, is the way most successful people have done that.
Let's suppose somebody makes a big fortune and he or she all of a sudden becomes a billionaire. Do they just call you up out of the blue, or do you kind of know that somebody took a company public, they made a lot of money, you call them up and say, by the way, how about some lunch, we could maybe help you? How do you actually get these billionaires or very wealthy people to be your client, or do they just come out of over the transom?
It's years and years and years of work and getting to know people, because this business is based on trust. And you don't just wake up one morning and find yourself with a great sum of wealth and then just go trust someone you haven't known for years. And so it is a very, very long journey to get to know people, to get to know their families, to help them with a piece of something along their journey. And the more you do that, the more you can find your way and to be able to give them the proper advice as they go through it. And the advice very often can be stay in cash, or monetize, or do nothing. Or look, it's not as much about talking about managing your money as it's talking about structuring your money. Let's figure out where we're going to hold it. Let's figure out how much you're going to give away, how much you are going to keep for your family, how much taxes are involved in the situation. And so there's just so many things that surround the advice that a wealth manager gives, and it's not just simply about the management of the money. Our place is to figure out how to ferret out those answers to the questions and then be able to apply a plan and work through that plan over time.
They wore their hair long, protested in the streets. How much isn't really known. Estimates range from a low of $15 trillion all the way to $68 trillion. Boomers may control as much as 70% of the country's disposable wealth. What happens when millennials get that wealth? Hard to say. It will depend on what the tax and estate laws are, plus the state of the stock market. One thing's for sure, financial advisors will have their hands full, both with those who are giving the wealth away and those who will receive it.
Let me talk about the great wealth transfer. Is that a difficult thing for families to deal with? They come in and say, I really don't want my children to really have too much money.
Charity, or you can give it to the government. And you just have to figure out which of those four buckets you want to have weighted in which manner. And there's no right answer. There's no wrong answer. You work so hard to make the money, trying to figure out how to impart your values on the next generation or on philanthropies or how you're going to live your life. That's not for any wealth manager to say. That is not our place. Our place is to figure out how to ferret out those still played themselves out during the pandemic that we are still going through today. The Great Recession that we experienced in 2008 was a very, very quick, rude awakening to the safety and security of assets. And so about $1 billion a day at one point was coming into the bank and trying to help people to understand the safety and security of their assets and understanding diversification is key, and you have to ride through these times. You can't be emotional because at the end of the day, a lot of wealthy people, they don't need their money tomorrow to be able to spend and really think about the fact that all of this money, I don't need daily liquidity at any one point in time. And so let me think about taking advantage and investing through those markets. And again, safety and security of my assets also came into play. And now you're seeing a constant flow of money to the firms where people are giving the good advice, are helping think through the long-term issues, and are not being short-term.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Let me give you my 3 rules of money management and see whether they comport with yours after you've been doing this for a while. Number 1, don't lose what you have. A lot of times my observation is people think that they made a fortune and they can double it or triple it, and they're willing to lose everything. They're not willing to, but sometimes they're taking risks that might make them lose everything if they're not careful. So what do you think about the principle of don't lose what you already have?
I think don't lose what you already have is a very, very good way of thinking about it. It would be unfortunate to find yourself where you have stretched so much in your risk-return trade-off that you find yourself in a downturn not being able to live the life that you had worked so hard to get to.
All right, my second rule of money management is diversify. Don't put all your eggs in one basket. I assume you must believe something like that as well?
Absolutely, 100%. And we find it all the time. And you can see it in today's market environment, as a for instance. Some of these things look very easy to make money in. Why? Because there's so much froth in the markets. There's so much liquidity that's pumped in by governments all around the world. And so what's seemingly easy may not be, and it may not have the same path going forward. And so one of the jobs of a very good wealth manager is to always stress test a portfolio and to say, I understand that this is what you have, and I understand this one thing has grown so much, but if that one thing were to have a stressed out moment, how will you feel? And are we sure we want to be holding on to that large of an outsized position in your portfolio?
So my third and final rule would be to have realistic expectations of what your rate of return is that you're seeking. If it's fixed income, be realistic about what you're going to get, or it's equities and so forth. Do you kind of tell people that there's different asset classes with different rates of return and they should be realistic about what they're going to get, or they all think they're going to double their money if they give their money to you?
10, 20, 30, 40, 50% returns on some of these asset classes for a short period of time. But if you look over the past 20 years, the average balanced portfolio has been 6.5% return. But 6.5% return compounded each and every year for 20 years is a very sizable return. And so if you look over the past year, many people have had average balanced portfolios up 30%. And then, of course, that's what they become accustomed to. And they want to hear from someone that's going to say, I can get you another 30%. But if something sounds too good to be true, that's probably another rule you should maybe add to the rule.
If it's too good to be true, it's not true.
If it's too good to be true, high likelihood that it is.
So if you are the head of wealth management, as you are, I presume every time you go to a cocktail party, and those were things we had before COVID and maybe have them again, cocktail parties, people ask you for free advice, I guess. What should I do with my money? Or what do you think of inflation? Do you have to keep up with everything going on in the economy in Washington, D.C.? How do you get briefed every day? Do you get briefed several times a day about what's going on to be able to answer questions?
Yes, I'm hoping cocktail parties come back because the Zoom parties are a little less fun. But the world really does feel much better, especially here in New York City. It's really starting to feel great and vibrant again, as it always does when it goes through these time periods, by the way. But the job of any money manager or anyone working in any field where they're responsible as a fiduciary for other people's money is that's your life journey. You are constantly trying to understand all of the components of what's happening. But I don't have to do that. No one person at JP Morgan has to do that for every asset class. We have subject matter experts in each and every field.
Let me ask you a few lightning round kind of questions. So what's the best investment advice you ever got?
If it sounds to be too good to be true, it probably is.
What is the biggest investment advice you would give to people about something they shouldn't do? They shouldn't invest in something. What should somebody not invest in?
You should never invest in something that can't be simplistically explained to you. And one of the problems on Wall Street is that people use lots of acronyms and make it very complicated to explain something. And generally speaking, it's like the difference between writing a long letter and a short letter. I didn't have time to write you a short letter, so I wrote you a long letter. The very, very good investment advisors can take complex matters and make them very simple. And when someone knows how to do that, and you can digest it and understand it, then you're allowed to invest in it.
If somebody called you up tomorrow and said, I'm not that wealthy relative to all your clients, but I do have $100,000, I'd like to put it somewhere, where would you tell that person to put their $100,000?
In a balanced portfolio, well diversified, that they can store away for a long period of time, and hopefully it compounds healthily for them.
What would you say is the greatest pleasure of doing the job you have? You're a wealth manager, but you're running one of the biggest wealth management operations in the world. What's the pleasure of it as opposed to the frustrations of it?
The real pleasure is helping the big pension funds that we manage. We were managing retirement accounts, right? And each and every little decision that we make now for someone's retirement in 30 or 40 years from now can mean an extra couple $100 a month for every year that they're in retirement. That can fundamentally change someone's life. I would also say the great pleasure for me for the past 25 years has been working at JP Morgan Chase, and to work at a company that can make as much of a difference in the communities that we're in, and to help the lives not only of the 250,000 people that work at our company, but the millions of clients that we have, and to be able to learn from each of them and share our learnings back with the others. I think that's a very special thing for me.